on YouTube, ma'am.
Okay.
Yeah. Okay, madam.
You just have a sip of water, come back.
Ma'am, you can start, ma'am. Roja, ma'am.
Okay, na?
Yeah.
కింద కామెంట్ లైక్ కామెంట్ ఆయన పేరు వస్తుంది ఆయన పేరు లేదా అఖిల్ పేరు మీరు ఇద్దరు పేరు ఇద్దరు పేరు ఎవరి పేరు రాదు
I request all the participants.
Roja, ma'am, please unmute yourself. I muted all the participants. Dear participants, don't unmute yourself and don't start your video. Please mute your video and audio for nice smooth presentation. Please do it.
Ma'am, Bhavani made a mute lo unnaru.
So there is a lot of background music going on. I think if we all keep ourselves in mute, it will be
Clear.
pollution free.
Okay. Once again, good afternoon, everyone. Welcome to the second day of 7-day national level online workshop on financial literacy on income tax and GST, a practical approach. Albert Einstein quoted, "The hardest thing in the world to understand is the income tax." But after listening to yesterday's workshop, makes believe that the whole 7-day workshops is going to be easily understandable for everyone. So let us start today's workshop. We have 3 sessions. First session is on heads of income. Second session is on set off and carry forward of losses and aggregation of income. Third session is on ETDS and advance payment of tax. So here we start off with the first session on heads of income, which is to be presented by Dr. O. Bhavani ma'am. Bhavani ma'am is a faculty member in Department of Commerce, Osmania University College for Women, Koti, Hyderabad. She has 24 years of experience in teaching both at UG and PG level with taxation and accounts as per specialization. She has acted as a co-investigator for a minor research project titled Mergers in Banking Sectors in India, a case study of select banks submitted to UGC CERO. Bhavani ma'am published 16 research papers and presented about 12 papers in various seminars and participated in workshops. Ma'am has also contributed lessons for distance education material of Mahatma Gandhi University and Osmania University. And Bhavani ma'am has received many awards for best paper at various seminars in the years 2014, 16 and 2018. Now, I would like to request Dr. Bhavani ma'am to take over the session. Thank you.
Thank you, Roja ma'am. Thank you so much, and thank you, Venkatesh sir. First, at the outset, I would like to thank the organizers for giving me this opportunity. Thank you, Ravi sir and Sandhya ma'am, for making me a part of this such a wonderful program. Right, and one more thing, before I start my presentation, I would like to record my grievance, one grievance that I have, the topic that is allotted to me, that is heads of income. My dear friends and all the participants, a very, very warm good afternoon to all of you. This topic, heads of income, the moment Ravi sir talked to me 4 days back and given me this topic, I was head off, frankly speaking, because 5 heads of income is what we learn over 2 semesters in our curriculum. And talking about 5 heads of income in 1.5 hours, I just went mad. I was not knowing where to start and where to end. So I thought of stepping myself into your shoes, and I'm not discussing, I'm just making one point very, very clear to all the participants. I'm not discussing any of the provisions. I'm not giving you any of the rates. All the textbooks are at your disposal. There's a lot of literature available on the internet. And what I'm going to share with you also that is available in the internet. But this is my experience as a teacher teaching the subject for the last 24 years. And then directly I'm getting into my presentation. My dear friends, people are always skeptical about taxation. When I was a student, there was one thing about algebra, gundagabra laga. taxes and day, always the subject used to be left over in the colleges, and students always used to get disturbed how to cope up with the syllabus, etc. And then coming February every year, we know how people at the administrative level are really bugged up with the policy issues, and managing a country like and after kickstarting our 7-day sessions with the yesterday's interaction with the stalwarts in the subject, both the Usha madams, I would say, they're the masters in taxation, and having had them for the 3 sessions the last day, actually starting this session on the second day, I'm feeling a little bit jittery, but I'll try to do what best I can do. Okay. Then, friends, Venkatesh Garu, see if possible, you can unmute some of the participants. Before I get into my presentation and I share, I would want you people to tell me what you think of taxation, or just 1 or 2 minutes time I will give you. What is that comes into your mind when you think about taxation? Yes, friends, please do not chat. Share with me.
Ma'am, it is very difficult to open all the mics. Okay.
Okay.
Better to post in chat box.
Okay, then fine.
Please,
So,
ma'am.
as suggested by the technical expert, friends, please share with me your opinions in the chat box. Okay, then I'll just proceed thinking that you people are sharing with me your opinions. Now I'll only start with this thing. Okay, what taxes are? I'm not getting into the basics. We all know. I like one statement that is made by the experts, the stalwarts in subject. Taxes are what we pay for living in a civilized society. Yes, I 100% agree with this, because I want all the benefits. The day starts, I want all the benefits. It rains heavily, I will be cursing KCR. I will be cursing KTR. I will be Instagramming KTR, etc. I think everything, they are the root cause for all the problems that we are facing. I want public transportation. I want uninterrupted power supply. I wanted this, I wanted that. But then, what is my contribution as a citizen of the country? If I stop for a second and think, mind you, friends, nobody would hesitate from the taxation of taxes, because I really feel happy being a part of this country and extending my support in little form, whatever I can, that the taxes that I am paying also is I am getting back in the form of various facilities. Now, I'll only ask you one question as advised by our Venkatesh sir. You cannot answer me back. Now, నాకు అర్థమైపోయింది మూకాభినయం చేస్తున్నాను నేను. మీ రోల్ నా రోల్ కూడా నేనే ప్లే చేస్తాను. I'll pose the questions, I myself will answer. Okay, then, right. Then, if you would start thinking or analyzing about all the taxes, then what different taxes are possible? Then, all the incomes, I'll just start with one statement. I'm responsible for paying off the taxes, which on all the incomes that I earned during the previous year, during the assessment year. This is one statement that I would want to pass. Now here I was covering previous year, assessment year, incomes, total incomes, earning, ting, so many things. Then I am focusing on that particular word, income. What is income? I'm not getting into the definition of income as defined by Income Tax Act. Now, for the purposes of convenience, right, all the incomes are grouped under various heads. Friends, I am sharing with you my screen, the little PPT that I thought I would share with you all. I'm just doing away with all this things. One second. Yes, right. Now 5 heads. So all our incomes can be grouped under 5 heads. What are they? Now, for every head of income, remember, there has to be a source. What is the need for the head? There has to be a source. What is the source? Every source gives rise to a particular income. Okay. So when I'm into employment, what is employment? It is nothing but you are rendering services. There is a contractual obligation between 2 parties, one to render and one to compensate the services that is being rendered by the opposite party. Then this is what we call as employment. Now in employment, there are always 2 parties, employee and employer. Then whatever I earn from my employment, it is termed as salary income, and it is grouped under each and every head of income is mind-blowing, and by itself it is an ocean. Now I started with telling that I have a little bit grievance with the organizers. My grievance starts here because it is ocean. Now I can only give you a bird's eye view of the content that I understood as a teacher in the process of learning all across my career the last 25 years. I have completed 25 years this July 13, friends. So this is only what I thought I would be sharing with you all. I'm not teaching you any provisions. I am making it very, very clear in the beginning itself. Okay. Now don't ask me what is 15%, what is 10%, what is 40%. No, I'm not dealing with any of the rates. Now come back. So I was telling you there has to be a source for generation of income. Employment is source for the income. Then I also have certain house properties. What about that? Then any incomes I'm generating by letting out my house properties, I am getting income from house property. Okay, I'm not happy with my salary income. I'm not happy with my rental income. I also would want to do some businesses. I have a boutique. Friends, and one more thing I want to give you a caution. Everything that I'm talking in the class is only example. For example, don't try to estimate my asset position with the examples that I am giving. Everything is fictitious. Okay. Then I have a boutique. Okay. I have a beauty parlor. I have a securities business. I have X business, Y business. Then various channels of income is possible. Then that business gives rise to income from business. If I have got more monies than the expenses, I am making profits. If I am got less monies than what I have invested, I am making losses. Then I do have assets, I have a property, I have lands, I have house properties, I have big cars, I have beautiful jewelry with me. Then I want to trade on securities and then make monies. Then these are called as capital assets. Every asset that I am disposing of could give rise to some income. So that is classified under income from capital gains. Friends, I always really admire the brains of the tax makers, the preparers of law, the way they have actually formulated such a beautiful subject. Now see, 4 heads, 4 తలకాయలకు పేరు పెట్టారమ్మా. పోనీ వదిలేసారా? వదలలేదు. See, they don't want to leave any income untaxed. So 5th head of income is called as residuary head of income. I like it calling the way I usually call it as a dustbin, head of income, because everything that cannot be accommodated under the 4 heads of income that we have covered just now. It is not income from salary. It is not your house property income, not your business income, not your capital gains. Then they get accumulated under the 5th head of income. That is what we call as residuary head of income. అంటే ఏంటి? రెసిడ్యువల్స్ అంటాము. మనం చక్కగా నెయ్యి కాచాం అనుకోండి, అడుగుని తెడ్డు తేలుతుంది. సో మిగిలిపోయిన చెత్త అంతా ఇందులోకి వెళ్ళిపోతుంది అనమాట. ఇది చెత్త కాదు. ఏ ఇన్కమ్ దే ఆర్ నాట్ లీవింగ్ ఇట్ untaxed. That is the beauty here. See, if you just go into details of income from other sources, they have taken all precautions to see to it that, yes, friends, I am seeing someone is raising the hands. What we will do is, after I complete this slide, you can raise the hands or reserve your doubts for the end of the session. Okay, because I have got a limited time, or else immediately you can just share with me your doubt. So I'm coming back again. So every income other than those incomes which are covered by the Income Tax Act, that is, which are exempted under section 10, rest all incomes are taxable under something or other heads of income. So the beautiful head of income is income from other sources. So any other source, I have shares, invested in shares. The return that I get on my investment is dividends. I have my investments in debentures. I have my investments in fixed deposits. I have national saving certificates. I have postal deposits. So any return that I am getting on this income, that is income, that income is taxable under the head income from other sources. So all incomes that are possible for a person to earn are classified under the heads of income. This classification is very much essential for easy understanding and also for seeing to it that you get into the assessment and post-assessment procedures very smoothly. Friends, am I clear? Shall I move on? Yes.
Okay, madam. Please go.
Yeah. Now, before I start with my income from salary, this is the data that the source is my, live mint of this thing. Yes, Anusha madam has raised her hand. Friends, as I was telling, I just don't want to get myself distorted. Please reserve your doubts. I'll have 10 minutes for the question and answer. Okay. Now, during the assessment year 2019, of the 34.1 trillion that we have collected as individual income taxes, 20 trillion, the chunk of the collection is from salaried class. So
Zoom
understand.
meeting, commerce, money.
So understand, 1 second friends, there is some background music, sound of music, please mute yourselves.
Okay, ma'am, clear.
So we should be very, see, the contribution towards taxes is very heavy from salary income. Therefore, we have to pay attention to this. Now, I just wanted to address on this particular issue what salary income comprises of. My dear young ladies and gentlemen, on this one topic alone we can talk for hours together, so I'm not wasting your time and my time. As I was telling you before, I'm not defining anything. Salary comprises of salary and it's a package. When you look into your payslip, it is actually a sum total of various items that are given to you as a part and parcel of the package that is promised to you at the time of your entry into the job, at the time of your entry into the service. Now, there's something called as pay grade or pay scale, which is applicable to quasi-government people and also the government authorities. But a private employee would also be getting a pay slip, would be getting his package. The primary heads will be his basic, DA, other allowances, variable allowances, etc., etc., etc. Now, your entire salary income comprises of your basic salary. Salary includes wages, fees, bonus, commission, arrears, advance of salary, etc., etc., etc. And salary is taxable either on due basis or on receipt basis. That is very important point. Then it comprises of various allowances and perquisites. Now, what is allowance? Allowance is that part of your salary which you receive in cash to meet a particular expenditure. Now, for example, all allowances can be classified under fully exempted allowances, fully taxable allowances, partly exempted and partly taxable allowances. I am taking up only HRA. Yenduko, I'll tell you the logic. I am not reading various allowances. I am not telling you the list of allowances that are exempted or taxable, but I would want to address on certain important aspects of one or two items which are useful for us. Even for a student, you have to pay attention to certain aspects when you look into salary income. Now, I again come back to this. Allowances is nothing but it is something that you are receiving as a part of salary in cash to meet a particular expenditure. What kind of expenditure? Expenditure could be my personal expenditure to meet my personal expenses, okay, and expenses to meet official expenses because of this particular job. Then certain other expenses which are given to me as a benefit because I am into a particular service like armed forces. I am putting up with all the disastrous climatic condition, uncongenial atmosphere. I am required to be staying at high altitudes. Friends, remember, coming the month of December, we like the warmth of our houses, warmth of our blankets. Now we are able to get this good night's sleep because of hundreds and hundreds of soldiers who are guarding the nation against all their comforts to give this comfortable sleep to you and comfortable day and night to all the citizens. That kind of discomfort that they are putting up with it, you can only compensate them in or by way of monetary benefits that you can give to them as a part of salary. So all your allowances you can split under different headings. Now, I told you my interest lies in partly taxable and partly exempted allowances. That too, I would want to focus on HRA. Friends, I would like to give you a small example. I have two daughters. This is example. Now, I got both my daughters married. Example starts. Then, I am fond of my daughters so very much. Okay. Then I also have two house properties, one in Manikonda, one in Jubilee Hills, nowhere less than these two places. Then I keep one my daughter in Manikonda and one in Jubilee Hills. My sons-in-law are happy that they got such a palatial buildings. Along with my daughters, they are comfortably settled. Now comes 1st of January, 1st of February, 1st of March. My sons-in-law, my daughters also are working. They have their HRA, house rent allowance, as part of their salary. What does that mean? This is an allowance that is paid to you as a part of salary to meet that expenditure of rent, house rent allowance. So to meet that rent, this particular allowance is paid. To avail this allowance, you have to fulfill certain conditions. What are they? You should be in receipt of house rent allowance as a part of salary. Yes, tick. My son-in-law, who is working in Microsoft, he is working in Microsoft, so he is getting his HRA. Fine, one tick to that. Second tick is, you should not be living in your own house. My son-in-law has got his apartment in Delhi, but he is living in my house, so this house is not owned by him. Second tick. Now comes the question. The third point states that you should be paying rent towards this. My son-in-law fulfills first two conditions. He is getting HRA. He is not living in his own house. But third condition is not fulfilling because I am such a nice mother-in-law and my husband is too good like me. We don't take any rent from them. So the problem comes here. My son-in-law cannot claim any exemption even though he is fulfilling two conditions for claiming this house rent allowance. How sad it is, right? Now, don't you worry, friends. If you are in the place of my son-in-law or my daughter or daughters-in-law or sons, remember, even daughters, you can claim this benefit by taking a house rent receipt from your father, mother, sister, even from wife also. Husbands, please don't get panicky or jittery if you have to take a rental receipt from your wife. So all the spouses in common gender wives, you can take from your husband, provided you are paying them rent, provided your spouse or father or mother or father-in-law is declaring that income as income from house property. So I come back to this example. My daughter, my son-in-law staying in my houses, I give them rent received. My son-in-law gives me a rental income of 15,000 per month every month. Then I also give him this. Then I show this income of 1,80,000 rupees as my income from house property. Then you should ask me a question. Ma'am, Meeru income from house property ga chupistunappudu meekem origindi. Why are you doing them this favor? Friends, remember, let us say I am retired. My incomes are not 2,50,000 or I am falling in 20% bracket. My son-in-law is falling in 30% bracket. We can save the taxes. We are not cheating the tax. We are not cheating the administration. We are only planning our taxes. So no tax laws prevents you from giving away accommodation to your kith and kin. Ekkada rasaledamma, mi ammaiki ivvagordu, mi abbayiki ivvagordu. No, you can give accommodation to your kith and kin, and you can as well give them the rental receipt, and they can as well claim HRA benefit. Because when we look into, now if you just look into this slide, don't you think I use these colors because of my creative nature? There is a purpose. These circles or vowels I kept in light blue. These are the only two places we have in salary income where we can plan our taxes. And I'm not getting into the details of the tax planning because we also have other experts to talk on those subjects. But whatever extent I can cover which falls within my jurisdiction of 5 heads of income, I would like to share that information with all of you. Fine. So these are the two places wherein we can plan our taxes. Now I was telling about my son-in-law. who is that? I'm talking about my first son-in-law. Now I'll give you the example of my second son-in-law who is staying in Manikonda. My son-in-law is working. Okay, Saka manchi business undi working. He has a business. He has no salary income. He has no HRA income. He is living in my house property. He is such a nice fellow. Without me asking only, every month he is giving me 20,000 rupees towards rent. Amma inta manchi intlo unnam, please you take this bolke. He is giving me 20,000 rupees. He is giving me rent, okay, every month. But he has no HRA. Then poor fellow, he is also giving me money, but okay, he is using my accommodation. What about the benefit? Friends, if you are in such a kind of a service wherein there is no HRA component in your salary, don't worry. There is one section called as 80GG which comes to our rescue. That is, 80GG is applicable to those people who do not get HRA component as a part of their salary, but who are living in a rented house. So if I don't get any HRA and I am living in a rented house, I can get the benefit to the extent of the least of the provisions that is provided by Income Tax Act. I can claim benefit under section 80GG of Income Tax Act. I think you all know section 80. We straight away take it to gross total income. We deduct all the deductions from GTI. So whatever is the admissible limit as per the provisions of Income Tax Act, I can claim the benefit under section 80GG. Have I made myself clear? Right then. Now, I will just take you on to perquisites. What is this perquisite? What is difference between allowance and perquisite? Allowance is that part of your salary which you are receiving in cash component to meet a particular expenditure. Perquisite is something which is provided to you as a benefit by your employer, which is provided to you as a benefit in kind, which is convertible into cash. But friends, our income tax department people, income tax officers, they are so brainy. Neeku cash vachinda, kind benefit valaki anavasaram. Nee chetilo ye benefit vachina kuda dani vallu taxable ga convert chestaru. So perks are such that you receive benefits in kind. Those benefits will be converted in the cash, and Income Tax Act has prescribed us the rates at which that particular perquisite is taxable. For example, rent-free accommodation. Now I am getting back. Again, perks also like allowances. Some of the perks are exempted from tax. Some perks are taxable in all the cases. I mean to say all the cases, I mean this is irrespective of the terms of employment, irrespective of the nature of your employment and the nature of your job, the cadre, the designation, etc. It is taxable in all the cases. Remember one thing, friends, any given point of time, it is our obligation met by the employer. I come back. It is our obligation met by the employer. It is always taxable. What is the logic? I'll give you an example. I'll come back to my daughters only. I have two daughters. I've put them in another school. I have to pay to my daughters 50,000 per annum. So 1 lakh total tuition fees I have to pay for my daughters. Now my employer is so very kind. I am such a crucial person for the organization. My employer pays my daughter's school fees. He gives me 1 lakh of rupees for the payment of fees. Now what is happening? I have put my daughters in a school. You forget what school it is. Whose obligation it is to educate the children. It is the I really feel very bad to use the word obligation. Obligation ane baruvuto kudikunnadi. Baruvuto bajyatato gadamma ishtamto chadivinchadam parents yokka kartavyam. I have to educate my children. So I put my children in the school. Then who is responsible for payment of fees? I am responsible for the payment of fees. Who will be questioned tomorrow if the fees is not paid? School authorities, school administration will question me. My employer is coming in between and paying the fees. Last year I fee pay chesaru. This year I fee chesaru. COVID ochindi. Then every year laga my employer pay chesadanu kuchunna. My employer has not paid the fees. Whom will the school question? School authorities will question me, because as a parent, it is my moral obligation to pay the fees. Are you all understanding? So here, if such kind of obligations, my obligation, my responsibility, my liability, my expenditure is incurred by my employer, is met by my employer, is paid by my employer, reimbursed by my employer, remember, it is always taxable irrespective of the nature of the perquisite. The logic being, in Japan, income tax people are like your James Bond, not 7. They're always after you where the incomes are, where the incomes are. Now you have to question me, ma'am, where is the income in this question? It is only school fees which he is paying. Girls, boys, I'm so sorry. It is my habitual mistake of teaching in women's college for the last 25 years. So please don't get perturbed whenever I use girls. I am habituated to calling the audience girls. I'm so sorry. I take back. So ladies and gentlemen, now say, so whose responsibility it is? It is my responsibility. Now where the income is there is no income. But there is one rule, one principle in income tax which states that any liability that is foregone is deemed income. Liability foregone is a deemed income. What is deemed? Deemed యొక్క అర్థం ఏంటంటే కాదు గాని అవును. It is not, but yes. Deemed income, it is not actually income, but it is treated as income. When I have to pay fees for my children, my employer is paying, it is my obligation met by the employer. It becomes taxable in all the cases. But then here, because it is a liability that is foregone, it is taken as a deemed income, which becomes taxable. I told you, not 7, they won't leave us. A liability foregone, come on, Dr. Bhavani, pay taxes on the liability that is foregone. Now you have to look at the half glass that is filled. Ayyo, income tax వాళ్ళు మన దగ్గర డబ్బులు తీసేసుకుంటున్నారు అనుకోకండి. 1 lakh నేను కట్టాల్సింది మా ఎంప్లాయర్ కట్టాడు. 30% ట్యాక్స్ పే చేసినా ఎంత పే చేస్తారు? 30,000. మిగతా 70,000 సేవ్ అయింది కదా. సో థింక్ లైక్ దాట్ అండ్ ఎంజాయ్ ద బెనిఫిట్స్. సో ఐఎమ్ అగైన్ కమింగ్ బ్యాక్ టు మై పాయింట్. Anytime, any perquisite, you or it is your obligation which is met by your employer, it is always taxable. Then there are certain other perquisites which are taxable only in the specified cases. Now friends, you all should focus on certain other perks which are extended to the employees by the multinational corporations. I really like their pay slips. The focus is more on such kind of perks which are tax-free in the hands of the employee. You are getting a benefit, you don't have to pay tax. Your euphoria will be very, very high because I am getting benefit from my employer. Only example, women's college of phone liver. My employer gave me a mobile. My employer gave me a laptop. My employer gave me something else. Now all these are benefits. I don't have to pack my lunch box every day. My employer serves me unlimited tea, unlimited coffee, beautiful breakfast, lunch, hot lunch, and again snacks in the afternoon or at 6 o'clock in the evening. All these are tax free. So I am getting a benefit. I am also not paying taxes. So these are some of the things. Now I am moving on to other receipts, section 10. I am not discussing anything. Section 10 is seal. It is given to you by your Income Tax Act. Those of the payments which are covered under section 10, they are subject to certain deductions like your gratuity, leave encashment, even HRA, etc. also. But friends, adrushtam ganakunte government employee ga puttundali, adi kuda before 2002. Mind you, all the emoluments they receive during the service, most of them, after the retirement, most of them are tax free in the hands of a government, it be state or central government. Poor chap, private employee, certain deductions are thrown on his face under section 10, but a portion of these payments are taxable in their hands. And another important benefit we can receive from our employer is leave travel concession. We all can pay attention even to that also. Then I'm taking on to one important aspect that we all should know as, people interested in taxation. For 16(1) law, standard deduction, there is a change this year. Last year it was 40,000. Your standard deduction is increased to 50,000 rupees with effect from the current year. Then I would want you all to focus on one important aspect, that is Form 16, friends. Remember, Form A, Form 16, most of the employees, even in Usmania University also, they must be receiving Form A's. The moment you are given Form A, you will just hold your head like Zabba Vachinda Bamala Rayalan. Friends, this is one way where you can plan your tax burden. do not hesitate. Most common mistakes that people do in Form 16 is they don't disclose their other incomes to the employer. They keep quiet. Employer takes into account salary incomes. Accordingly, taxes will be deducted at source, and you are left out with another chunk of your total income, your other incomes which you have not accounted in the Form 16 and on which you have to pay taxes. If you forget or if you fail to pay advance taxes on these other incomes which you have not made it part of your Form 16, remember, you fail to pay the taxes, you pay the taxes before the due date, you are subjected to interest on delayed payments under section 234A, B and C of Income Tax Act. Therefore, please do not do that mistake. If you have income from house property, declare to your employer. If you have income from other sources, declare to your employer, because accordingly your taxes will be planned, and 31st of March you can receive your salary nicely, and by that time you must have paid all your taxes. You can have a good night's sleep. Think about filing your returns till 31st of July or extended dates every time by the Government of India. Okay, therefore pay attention to this one aspect. Then I would want to discuss about this National Pension Scheme. I think ATC tax planning they might be covering. It is not directly related to salary, but because employer is involved, I wanted to lay emphasis on this National Pension Scheme. This is started by the Government of India for the benefit of those of the employees who are not subjected to the pensionary benefits. Here both the parties will be contributing, both employee and employer. My interest lies in 80CC1B and 80CCD2. 80CCD1 is whatever I am contributing towards my pension scheme. It is part and parcel of that maximum limit of 1,50,000 rupees as covered under section 80C. But then if I am contributing an additional, that is to NPS, an additional amount of 50,000 rupees is allowed to me as reduction over and above 1,50,000 rupees. And most importantly, if my employer is contributing, whatever my employer is contributing to the extent of 10% of my basic and DA is tax free in my hands. I am getting double bonanza. One is my employer is contributing for my benefit. The second thing is it is also tax free. Okay. Therefore, if my I think I have around 171 participants, minus 1 me 170. How many teachers are there, etc., or those of you are having some incomes, plan like this. If you are not covered under any pension schemes, I think you can pay attention to National Pension Scheme. Okay. Friends, there are a lot many things to be dealt under section 80. I am not touching 80 because this one thing is, I just wanted to discuss with you all to bring that awareness. Now I am moving on to the second head of income. Excuse me. This is old age symptoms. Now income from house property. Okay, I have got salary income, fine, we have discussed. I have got house properties also. Now my problem is I have one house property, two house properties, three house properties, or I have only one house properties. What is it that I am required to be doing? I will be paying taxes to the local governments in the form of municipal taxes. I will be paying various cesses, etc. Then am I going to get any benefit? Then, okay, my properties are there, they are remaining vacant. How do we consider them? Okay, I have let out my property, but my tenant is not paying me rent. Do I have any solace? Then, yes, I have property, but it is self-occupied. Then what are the ways and means that are available in the law? Then what about that interest that I am paying on the loan that I have taken to construct or to develop or to renovate or repair these house properties? For all these questions, yes, there are answers. Friends, the income that you earn from your house property, as I was discussing with you, source is house property. Again, conditions are important here. I'll give you an example of story of the chinna story, 2 నిమిషాల story meeku. మా అన్నయ్య US లో ఉన్నాడు, నిజంగా ఉన్నాడు ఆయన, మిగతాదంతా example. Now he loves me so very much. ఇది కూడా example కాదమ్మా. Then he has a very big property in Khairtabad. Okay, he has let out that property. Every month he gets a rental income of 1 lakh rupees. So his total rental income is 12 lakhs. I am the only sister my brother has. So what my brother does is, he is a billionaire in US. He says, Amma, నాకు ఇక్కడ చాలా డబ్బులు ఉన్నాయి, నువ్వు చక్కగా నీకు డబ్బులు చాలానే ఉన్నాయి, okay, you enjoy this rental income, I don't want this rental income, okay. Every month he transfers that money into my bank account. I go to Tanishq 1 month, Malabar 2nd month, 3rd month Kashish, 4th month Ting, 5th month Ting, 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 Ting. Now it is none of the business of the income tax department what I am doing with this 12 lakhs. The business is my brother's property, my brother's rental income, my brother's love for his sister, the sister who is enjoying the benefits. Anta ayipayindi chakkaga. Now comes one point, who has to pay taxes on this 12 lakhs of rupees? Me, who is enjoying the fruit, who is enjoying the benefit, or my brother, who is the owner of the property? Friends, when it comes to the terms of payment of taxes, who is reaping the fruits, who is enjoying the fruits or the benefit is irrelevant. Ila ganaka avute manaku asalu clarity e undadu, especially in a country like India, we will never have a clear picture as to who is responsible for the payment of the taxes. So for house property income to be taxable in your hands, you have to fulfill two conditions. What are they? Property should be situated in India. Then you should ask me a question, ma'am, I have property in Singapore, am I not liable under income from house property? Don't underestimate your income tax department. It is taxable in your hands under income from other sources, but not under the head house property, okay. Tax cheyakunda undam mimmalni kate ee head lo consider avvadu. So I should be having the property in India, and I should be the legal, underline this inverted quotations, legal owner. La paranga nenu owner ni. Whoever is the legal owner, the burden is on the legal owner for the payment of the taxes. So here, though I am enjoying the 12 lakhs, next it may be 25 lakhs for example, but poor fellow being the owner of the property, my brother has to pay the taxes. My brother has to compute his income from house property as per the provisions of Income Tax Act. Then my brother is paying municipal taxes. Yes, there are certain other problems I will discuss now. So any municipal tax that I pay to the local government, any taxes, thus I pay, again underline, nenu pay chesindi matrame. If I am not paying, I am keeping it as a due, I cannot claim any benefit. Or I am such an intelligent owner, I agree upon with my tenant that along with the rent, my tenant has to pay the local taxes. Poor tenant is also agreeing for this condition and he meets this expenditure. Then, yes, municipal taxes are levied by municipality, municipal taxes are paid. But who is paying the taxes? My tenant is paying the taxes. Can I claim the benefit? No, because I have not paid the taxes. Is it clear? So any municipal taxes I am paying, I can claim the benefit. Unpaid, I cannot claim the benefit. Then, if I have more properties, till last year, I can keep only one house as a self-occupied house. Remaining house properties, I have to take them as deemed to be let out house properties, deemed to be let out house properties. Then I have to compute my income from house property. But this year, I am allowed to claim 2 houses under self-occupancy. So then again, I'll go back to same example. I have 4 house properties, for example, again, in Vidyanagar, in Medipatnam, in Manikonda, in Jubilee Hills. I am so fascinated with my properties. I kept my Manikonda and Jubilee Hills property for myself. Oka varam ikkada untanu, oka varam akkada untanu. Both the houses are furnished. Now this year, yes, I am saved because I can retain 2 houses under self-occupancy. This is the benefit that I got from the Income Tax Act this year. Okay. Then comes, what about the taxes? Yes, a self-occupied house property's annual value is always taken as nil. I don't have to pay anything more. So if I have borrowed funds, I have taken loan for the construction of the house property, then whatever loan I am paying, repaying, loan repayment always comprises of 2 portions. One is principal, the other is interest part of it. Principal is accommodated by section 80C within 1,50,000 of course, and interest is accommodated by section 24 of Income Tax Act, wherein I can claim deduction from my incomes under the head income from house property. If you are a let out house, any interest that you are paying can be claimed as a deduction, but for a self-occupied house, till last year it was 1,50,000. This year they have increased it to 2 lakhs of rupees. Any loan that I am borrowing after 1st April 1999, I am entitled to a deduction towards interest on loan under section 24(2) to an extent of rupees 2 lakhs for a self-occupied house property, to the extent of the actual interest that I am paying to the banker or a financial institution for a let out house property. Here again, I would like to emphasize on one important point. Friends, those of you are planning your taxes who want to get into construction for claiming benefits, there are 1 or 2 more benefits also which I'm going to discuss now. Remember, you have to take financial help only from a financial institution. Any nationalized or scheduled bank or your LIC finance, etc., etc. Don't borrow or don't take hand loans from your family or kith and kin or your friends, etc. They are helping you. You're also saving on your interest component, but no loan will be allowed to you. If you are paying interest at a nominal rate also, that interest will not be allowed to you as reduction because you are not borrowing from financial institutions. So in order to get the benefit on account of repayment of loan with interest, you have to take the loan from a financial institution. So this interest component is applicable both for the let out house property and also for the self-occupied house property. So for a self-occupied house property, invariably you will be resulting into loss. I'm not touching upon what has to be done because next session Sandhya madam will be dealing with set off and carry forward of losses. So self-occupied loss మీరు ఏం చేయాలో నేను చెప్పను, వేచి ఉండండి. Okay, now come back. So now let out house property, yes, I can claim. The beauty of this particular head of income is the scope of this income is very, very small, very, very short and sweet. No other item will be allowed to be made part of this income other than those which are mentioned. 2 deductions, 24(1), 24(2), and how you ascertain, sometimes notional, you will be talking about municipal rental value, fair rental value, standard rent, etc., which becomes expected rental value when compared with your actual rent. Whichever is higher will be taken as your annual rental value. Now I'll go back to these 2 points. What if my house remaining vacant? What if I did not realize? Both the points I'll cover. I'm not telling you any provisions. I'm only telling you there is a scope for getting the benefit. Friends, yes, I have these 4 house properties. 2 I kept for my self-occupancy purposes. 1 house property or 2 house properties at Vidyanagar and Mehdipatnam I have let out. Now, the tenant who is staying in Mehdipatnam property vacated the property because he got transferred on 1st of December. Now, during the previous year, 2021, my house remained vacant for 4 months. That is December, January, February, and March. Now, I got rent only for remaining 8 months. So, is it not wrong on the part of the government or the income tax department if they're asking me to pay taxes on the income for all the previous year because I have not received income for the 4 months? Yes, in case your house property is remaining vacant, you are entitled to get this benefit of vacancy allowance, which will be adjusted out of your annual rental value. So to that extent, you don't have to pay taxes and you will be bringing down your taxable incomes. Okay, now coming to unrealized rent. What is this unrealized rent? Okay, now I have let out my property at Vidyanagar to a tenant. He is a business person. He occupied my property throughout the previous year. Then January 1st onwards, he stopped paying me rent. He is living in my house. Jan, Feb, March, he didn't pay me any rent the previous year. Now what is happening? Though the property was let out, my tenant did not give me the rent. That is called as unrealized rent. If any unrealized rent is there, after fulfilling certain conditions laid down by the Income Tax Act, you can adjust unrealized rent out of the actual rent, okay? And the remaining actual rent only will be compared with expected rental value. Between the two, whichever is higher will be taken as your net annual value or the gross. Is it clear, friends? Then, okay, now interest portion also I have covered. Fine. I'll give you another example. Friends, let us say I started construction of my house property in the year 2015. Okay. Now I approached State Bank of India and took a loan of 1 crore rupees, for example. I started construction of the property. It is ongoing. Then 16 or 17, let us say 1st April for the convenience sake. I take the date as 1st of April. 1st of April 2017, my house property is completed. Construction is completed. It is ready for occupation. But what did I do? I borrowed finances from State Bank of India way back the year 2015. When is my house property completed? 2017, 1st of April. Now, all along these months, 15, 16 till 17th of April, do you think that my banker would be keeping quiet for me to complete the construction, wait for me to either occupy the property or give on rent, get the monies and pay him? No, he won't keep quiet. I have to start making my repayments, right? Interest and also principal. Now, I cannot claim this interest because for claiming interest under 24(2), the property has to be completed. Here the property is not completed. Then how can I get the benefit? Am I not losing my money? I'm spending but I'm not getting any tax benefit. That is addressed by one concept, that is pre-construction period allowance. Friends, I always think like this. The vocabulary, the words we use in commerce, especially subject like taxation, is self-explanatory. Look into the word pre-construction period interest. That is the interest that is attributable to the period before the construction of the house property. So whatever interest I have paid to my banker before the completion of the construction, that entire amount is pulled up and that is called as pre-construction period interest, which will be allowed to me as deduction in 5 equal installments from the year of completion of the construction. When my construction is completed, 1st April 2017. Starting from the year 17-18, I can claim 1/5 of my PCPI for 5 years. 17-18, 18-19, 19-20, 20-21 and 21-22. I am entitled to this. Is it clear, friends? Then majority of us get one doubt. What about the maintenance expenses? Friends, okay, we have house properties. We are living in some and we are also letting out. We are getting rental incomes. But as the houses age like us, okay, you have to incur some expenses like maybe whitewashing, repairs, changing of taps or pipelines, this or that. Something or other will crop up. Illu antu unte ఏదో ఒక ఖర్చు మనకు వస్తూనే ఉంటుంది ఎప్పటికీ కూడా. Then how is that addressed? You are talking about rental income. You have defined the scope of income. You want Income Tax Act. They have defined the scope of income tax, right? The scope of house property. Then what about my maintenance expenses? I am incurring. Is it not unfair on you to ask me to pay taxes on the rents that I am collecting and you are just neglecting the maintenance expenses? Friends, this question is addressed by the Income Tax Act by one deduction, that is 24(1). A statutory deduction at the rate of 30% of NAV is allowed to you. This is to help you in maintaining your house property. The purpose of 24(1) is nothing but maintenance expenses. Okay, one thing is when it is a newly constructed property, you don't have to incur more. It is old, you might be incurring more. Okay, but it has got nothing to do with that. Your 24(1) is a flat deduction irrespective of the amount of the rent you are collecting, irrespective of the amount that you are incurring as expenditure towards the maintenance of your house properties. Why? Because this is one loose what should I say, way. There is a lot of scope for manipulation. Friends, if Income Tax Act were to state, yes, my dear house owners, whatever expenses you incur on maintenance, okay, I am allowing you as deduction. I bet not a single owner would come forward claiming that he has not incurred any repair expenses. He will say whitewashing 1 year, he will say changing or coloring this or that, or changing the doors for the bathrooms, etc., changing the tiles the next year, changing the pipelines the next year. A lot of scope for manipulation. So to avoid this, Income Tax Act restricted. There is no consideration for any actual expenditure as far as your maintenance is concerned. So you have to ignore any amount that is spent by you, because your maintenance expenditure is addressed by way of a flat 30% statutory deduction on NAV. Now, these are the few points I would like to pay attention to. My dear friends, most of us might not be knowing 80EE. As I was telling you, deductions, tax planning, etc. is being covered by some, but because it is related to house property, I would want to pay attention to. You are actually taking a loan for the purposes of a residential house properties, right, acquisition or construction for the first time. The most important thing is during the financial year 2016-17, and if your loan amount is less than 35 lakhs, your property value is not exceeding 50 lakhs, and you are not owning any other residential property, then you are entitled to claim a benefit of rupees 50,000 rupees under section 80EE of Income Tax Act. So those of you who have borrowed monies for the first time to become an owner for the first time, right, in the lifetime, during the period 16-17, you can claim this deduction. The deduction is applicable till the loan period, till you have repaid your last installment of loan. Next important deduction is 80EEA. This is also in relation to the payment that you are making towards the interest for loan taken for the construction of the house property. Same conditions are applicable, and you must not have claimed any benefit under section 80EE. Then you are subjected to a deduction of actual interest that you have paid, or 1,50,000 rupees, whichever is less. Is it clear, friends? And you should have borrowed. This is actually made applicable from the year 2017 onwards. Okay. Then, friends, the most important point. Next session, Patrick sir should forgive me for discussing about 194I and IB, because I thought if I am, including that or making it part of income from house property, it would be good for the takers also. So I am talking about these 2 points. Friends, most of us do not know that even the rental income that you are paying, the rent that you are paying to your owner is subjected to TDS, and you don't even have to have a TAN number also. It is covered under 2. First, I'll talk about 194B. 194B IB is TDS. It is applicable for the individual to individual payments. My tenant is paying me rent. It was earlier 1,80,000. Now it is made 2,40,000. I have got 4 properties. I have let out 2 properties. Property 1, I am getting rental income of 3 lakhs. Property 2, I am getting rental income of 5 lakhs. So both my tenants, because my rental income is exceeding 2,40,000 rupees, they are liable for taxes that are to be deducted at source at the rate of 5%, and then only pay me the balance of the amount. That is very, very important, friends. And 80IA is, this is for those of the people, that is other than individual, for business purposes you are giving. Then here it is, sorry, I just, mixed up 2 sessions. 194I, 2,40,000. 194 IB, if you are paying rent in excess of 50,000 per month. Let us say one of my tenants is paying me 6 lakhs. Okay. It is not subjected to. I am getting 6 lakhs and 50,000. It's subjected to TDS, and he is required to deduct taxes at source, even though he is not having any TAN, at the rate of 5%. 194I is applicable in business classes wherein the property is hired for running the business, etc., etc. If you are exceeding 2,40,000, it is subjected to 10% of TDS. Friends, I think you all must have read in the newspapers, because of COVID, all the TDS rates are given a concession. Now there is 1/4 reduction in the rate at which your taxes are being deducted at source. But ultimately, as per the slab, it is your responsibility to pay the taxes. ఇప్పుడు 7.5% చేస్తే ఏంటి, 10% చేస్తే ఏంటి, ultimately it is your responsibility to pay the taxes. Okay, friends? Now, I'm moving on to third head of income, that is profits and gains from business and profession. There are lot many things, lot many items, lot many sessions here. I'm going to address three important aspects which I thought important. Might be, might not be. Okay. Then I am discussing about the general principles for admissibility of expenses. Then why certain contributions are allowed as reduction. Then I am discussing about presumptive taxation. So this is what I am going to address from this chapter. Friends, remember, for any business income, like I'll give you one example. I'm a businesswoman. Fine. For example, I'm running my business. Now, for running the business, I have to incur various expenses. Okay. Now, Income Tax Act says, madam, you keep aside, set aside all your expenses. Whatever is your turnover, pay this much per. Whatever is your income, pay taxes. Then why would any person on head on his neck would come and do the business? Okay. Now, there are to be certain deductions which will be allowed to you to bring down your taxable incomes. That is what there are certain general principles which govern the admissibility of expenses when we are preparing our business incomes or when we want to claim deductions under business or profession. So you claim your expenses, you prepare your incomes, you have various incomes from various sources, you have multiple activities, multiple channels, each and every channel of business is a separate business and you have to compute business line wise. Of course, all the incomes you will group under one head only, but I have 5 different lines of business. I have automobile industry, I have a jewelry shop, I have a garments industry. Then these 3, I have to separately ascertain my incomes and group all 3 at one place under business income. So the most important point for me to claim any expenditure as an admissible expenditure is the principle of commercial expediency. Then what is prudency? Right, girls, friends, commercial expediency is that part of your expenditure which is justifiable, which is logical, which is rational, which is reasonable, and which is a must for any business or your kind of a business to incur. I'll give you an example. Okay, I am into a manufacturing business. Fine. Then I need management graduates in finance. My daughter, for example, is IIM finance. Then I hire the services of my daughter. As I told you before, no law prevents you from hiring your blood relations. No law can prevent. But here, one thing that is important is, let us say, the kind of the job that my daughter is doing in my company. A similar organization is paying for a similar job 50 lakhs of rupees. Okay. Then I am paying my daughter 1 crore rupees every year. Okay. Now, the problem is, there is no problem if I am hiring my services of my daughter. There is no problem as long as the expenditure is commercially justifiable or commercially expedient. Here, 50 lakhs is the market rate, but I am paying more to this particular person. What is the reason? Because she is my daughter. So that 1 crore rupees of salary that I am paying to my daughter is not commercially viable or expedient or prudent over and above 50 lakhs of rupees. Are you all getting this? So that is very, very important. And most important points are the expenses that I am claiming as deductions need to be incurred by me. Me means I am the owner of the business. I am running the business. These expenses should be related to that business where I am claiming them as expenses. They should be revenue in nature. They should not be capital in nature. Okay. So, and they should be incidental expenses. Like if I am doing a business, I have to pay salaries, I have to pay wages, I have to have my office and establishment expenses, running expenses, maintenance expenses, purchase and sale. Okay. So all such expenses are allowed to be claimed by me as admissible expenses, provided I fulfill these conditions. I am the owner. I am incurring during that accounting period. These expenses are related to this particular business. Okay. Let us say I have 2 cars for the business and 3 cars for my residential purposes. I have hired the services of 5 drivers. Then I am paying salaries to all 5 drivers and I claim in my profit and loss account salary to driver 18,000 into 5. Am I allowable to do so? The 2 cars that I am using for business is allowed to me as deduction. The remaining 3 cars is inadmissible because that becomes my personal expenditure. So no personal expenditure can be claimed by you. No capital expenditure can be claimed by you. I am purchasing plant and machinery for the business. You will ask me, ma'am, business ke kontunnaru kada. Aithe enti? No capital expenditure is allowed excepting for those which are into scientific, research and development. No other capital expenditure is allowable to be claimed, but you can offset that expenditure by claiming depreciation as per the rates applicable, because depreciation becomes business expenditure. Depreciation is that part of the reduction in the value of the asset because you have put the asset into use for the purposes of the business. Okay, then I cannot claim any expenses which are strictly prohibited, and I have to incur these expenses for my own business, for the same business. As I was telling you, I have 5 different lines of business. I cannot claim expenses that I have incurred for boutique business again as the timber business or the garment business or vice versa. So a business ka business then account cheyali. Then expenditure of a discontinued business, I cannot claim for the running business. If I am carrying any single transaction, then all the, which is in the nature of a business, all the expenses which are attributable to that single transaction will be allowable to be claimed as deduction if you are fulfilling these conditions. Now, again here I would like to focus on, friends, from here, remember, any expenses which are not directly related to the business, you cannot claim any deductions. There always has to be a nexus, a link between the business and the expenditure. If you can establish the link and satisfy all these conditions, then we can claim such expenses as admissible expenses. Then these are the most important items which I felt like, if you are carrying in-house research, you are signed that you are engaged in a manufacturing activity, all expenses you have incurred, both capital in nature and also revenue in nature, are allowed to be deductible till the last penny of expenditure is exhausted. Let us say I have a capital expenditure from research activities other than purchase of land, then this will be allowed to be claimed. Let us say during that year, last penny of profits are available. After writing off, I am allowed to claim or carry forward this till it is exhausted completely. Okay. So then apart from that, now these are certain contributions which I am making out of my business income. I am not spending for the businesses which I am running. They are not related to me. I am not the owner. Still I am making the expenses, I am incurring the expenses and I am getting the benefit. Why? In the larger interest of the society, Income Tax Act is giving you or extending you this benefit. What benefit? If I am contributing for the purposes of any a contribution I am making to any approved institution for conducting the research, or in the social sciences area also, or I am contributing to a national laboratory, or I am contributing to a company which is involved into scientific research and development, I myself I am carrying out in-house research. In all these cases, whatever contributions I am making, I am entitled to a deduction to the extent of contribution that I am making. In some cases, even weighted average deductions also are applicable. If I am contributing 10,000, I am entitled at 125%, or 12,500 I can claim as a deduction. Why? What is the logic? The logic, as I was telling you, here when people like us, we are contributing. I am not the one businesswoman or one businessman. There are several hundreds and thousands of people like us who are interested to make these kind of contributions. We are contributing. Then where the money is going? Money is getting into the nation. It is actually being pumped into the nation. It is getting into your economy. It is useful for the purposes of developmental activities like this. That any research activity, friends, it is no joke. You have to invest crores and crores and crores of rupees. Very soon, we might even be celebrating 1 year of lockdown next March 16. We have seen what is happening in the COVID, right? Most of these big pharmaceutical companies and big heads are into the bringing out of vaccination. Are we successful? We are talking about Pfizer 1 or this and that, but it still takes 1 to 2 more years for the vaccine to reach the common man. And think, apart from the man hours, that intelligence, that human resources, what kind of money is required to be pumped into such kind of activities. So government is no fool. They are giving you this benefit to encourage more such kind of contributions, because now we are working in the larger interest of the society. For that reason, these are allowed as deductions. Excuse me. Then I will just discuss about this presumptive taxation. Friends, the beautiful part of your business income is there is this concept of presumptive taxation. Presumptive ante presumption inch ochindi. Ante enti? The moment you look into this word thing, actual so manaku sambandham ledu. How is it being worked? Why it has to be incorporated or introduced by the Income Tax Act? Presumptive taxation is introduced in order to protect the interest of the small scale business houses or the business people, the retailers, etc. So these are covered under the provisions of sections 44 AD and other sections also, which I am taking up now. Now this is meant for the benefit of those small businesses, that is 44 AD, excepting for those businesses who are into plying business, hiring or leasing of the goods, carriages, etc., as is covered under section 44 AE. If you are a resident individual, if you are a Hindu undivided family or a resident partnership firm other than a limited liability partnership, that means LLPs does not come under the benefit of 44 AD. There are certain conditions also. So if I satisfy these conditions, I am a resident individual, I am a Hindu undivided family or a resident partnership firm, if my total turnover is less than 2 crores of rupees, okay, then I can declare up to 8% of my gross receipts as my income and accordingly pay the taxes. This is called as presumptive taxation. There are certain conditions. If my gross turnover exceeds 2 crores, I am not entitled to claim this. Okay, the moment it is exceeding 2 crores, automatically this benefit will not be extended to me. Secondly, if I am opting out for 44 AD, entire burden is on me, the business owner. I have to declare my income. I don't have to maintain any books of accounts. I don't have to get my accounts audited, because they are asking me to declare. I can declare up to 8% of gross receipts as my income. I don't even have to maintain my books. Friends, after demonetization, India is moving towards digitalization. Today, everything we talk in terms of digital. Our web today, seminars are no longer seminars, they have become webinars. The reasons are so many. COVID, etc. Maybe this may continue for a long time with COVID or without COVID. Today, thanks to the technology, we being located at different places, approximately 175 us could be part of this program because of this technology, the digital technology that we are into. So sorry for deviation. So what government did was, if you are selecting to digital mode of payments to encourage you, I always tell in taxation to my students, if you are receiving any benefit from the government of India in terms of a benefit, let it be a deduction, a rebate, or whatever it is, always remember it is an eclair. They in turn take Cadbury's or a silk chocolate from us. The benefit here is, now what they did was, you have to declare 8% of your gross receipts. You are covered under 44 AD. After digitalization, you are resorting to all digital payments. You made all your payments online by net banking, RTGS, debit card, credit card, ting, all those that fall under the definition. Then you are eligible to claim only declare 6% of your gross receipts. So that will be taken as your income, and mind you, no other deduction will be allowable to you. You cannot claim any other deduction. So on this income, you can pay taxes as per the rates applicable. Now, here, once I have opted for preemptive taxation, friends, I have to be in that group only. If I choose to come out of it, the next 5 years, I cannot again take benefit under preemptive taxation or presumptive taxation. As I was telling you, I am not even required to maintain any books of accounts. So what we discussed was AD. This is 44 ADA. Simply speaking, that is for small traders, small manufacturers, etc., etc. This is applicable to professionals. Okay, doctors, lawyers, medical professionals, engineers, architects, accountants, etc., etc., etc. Now, for these people, they have a choice of declaring 50% of their gross total receipts as their income from profession, and accordingly, both the cases, AD and ADA also, the SSEs are at their choice to declare voluntarily at any rate higher than 6%, 8% or 50%. If a professional is coming forward and declaring 60%, we are no fools to stop him stating that, Are Baba, you have to show only 50%. No, we will not do that mistake. If you claim 70%, you declare 80%, I take 80%. But minimum you have to declare 50% of your income. On that, you are subjected to pay taxes as per the rates applicable. Here also, you are not allowable to claim any other deduction. Okay, no depreciation, no deduction. Friends, those of you who are opting for 44 ADA and AD, remember, you have to finish off your tax liabilities in the form of advance payment of taxes before 15th of March every year. Okay, you pay completely, then you can enjoy the fruits. If you are defaulting, then there are various sections of income tax which take you to task. Okay, and the life fines, penalties, etc., etc. I am not addressing all those issues. So what is important for us is, it is not enough if you are a prudent businessman in terms of your business acumen. You also have to be careful and well equipped with this kind of a knowledge, and check every year which is beneficial for you, either to compute your incomes as per the normal procedure, that is the provisions of Income Tax Act, or choose presumptive taxation. So what is supposed to be done by you? Prepare your accounts as per the Income Tax Act, then take out 6% or 8% or 50%, whatever is applicable. Now calculate the tax liability as per the rates applicable. So what you should be doing? Use your brains, and where your tax liabilities is less, you have to choose that. But don't make the mistake of walking in and walking out. There is self-check mechanism here. If you are walking out, elevator and tax guda, you are walking out, you cannot walk into again for the next 5 years, it is seized. The day you are walking out of presumptive taxation, again, your maintenance of books of account is dumped on you. You have to maintain your books, you have to compute your incomes, again pay the taxes, no benefits under presumptive taxation. With this, I'm done, and I'm taking you to the 4th and 5th heads of income. Friends, frankly speaking, the little time organizers have given me, I have given weighted averages, and I've given more time to the first 3 heads of income because I thought I can discuss more points. The next 2 heads, I will be focusing only on the latest changes. Then we will also try to interact in the end. Hope I am clear. Friends, I am not following your chart boxes. I think I am clear. Okay, now capital gain. The 4th head of income is a capital gain. Gains vastayani ekkadanna namakam unda, losses kuda undachu. There can be a loss, there can be a gain. Any property that you are owning, excepting your personal effects, adu vadilesaranడి papam. Malla andulo kuda jewelry is not left out, gold bullion is not left out. Okay, then anything that you call your personal effects, or your owner of agricultural lands in the rural areas, gold bearer bonds and special bearer bonds, other than these assets, rest all assets I own, they come under the purview of this particular head of income. Assets are classified on the basis of period of holding into long term and short term. We have 3 different periods of holding: 36 months for all other assets, 24 months for immovable properties, 12 months for financial assets. I am holding any other asset for more than 36 months, financial assets for more than 12 months, immovable properties for more than 24 months. They are called as long-term capital assets. I am holding for less than 36, less than 12 and less than 24. They are called as short-term capital assets. The difference, the distinction is very, very important in terms of 2 aspects. One is your indexation, the other is your tax liability. And more so, you should be all the more careful if you are dealing with your financial securities or financial assets like shares, etc., because the sale, the shares, the capital gains also are subjected to different tax rates. Short-term capital gain tax is there at 15% and long-term capital gain tax is there at 10% flat. Of course, you will have to take into account your basic exemption limit and other story remains same. But then the 2 aspects that you have to pay attention to is the indexation, that the difference between long-term capital asset and short-term capital asset is the element of indexation. This also, they have made changes 2 years back. Earlier, we used to have indexation with effect from the financial year 90 onwards. That was taken as the base year. But now currently, they have made the changes and reframed this starting the base year as 2000-2001. So what they did was 1991 kasta 2000-2001 base year ayipindi. So all the assets acquired by you prior to 2001, the cost of acquisition. What is cost of acquisition? The cost at which you have acquired an asset. Madam, why should we need to know this cost of acquisition? If you don't know at what cost you have acquired this asset, how will you ascertain your gain or loss? So for that purposes, cost of acquisition plays a very, very crucial role in capital gains. It includes all those incidental costs which you are supposed to be incurring from the place of purchase till the place of installation. The expenses will have to be capitalized by you, and that entire thing will be taken as cost of acquisition, and that is the basis. So if I am purchasing or acquiring any asset prior to 2001, the cost of acquisition will be taken as the fair market value or book value, whatever you call so, or the actual cost at which you have acquired that asset, whichever is higher will be taken as cost of acquisition. The assets acquired by you after 2001, as it is, you have to find out indexed cost of acquisition. Now, you should ask me, ma'am, what is the purpose of this indexation? Friends, this is one thing which is very, very important. I'll give you an example. Like, let us say, I have one property which I have acquired by way of inheritance from my grandmother. Again, example. My grandmother purchased this property way back in 1971, year of my birth. I don't feel like hiding my age, girls, friends. Yes, in the year of 71, my grandmother acquired this property. Now, she wanted to transfer this property in the year 2019. She has 1,000 square yards of land, which she acquired only for 1 lakh of rupees way back in 1971. Now, my grandmother wants to sell 1,000 square yards of that property. That price is mind-boggling because she's selling 1 square yard for 1 lakh of rupees. So how much of money she is making? Huge money, crores and crores of money. Now you ask my grandmother, madam, you got 10 crores as your consideration. Now you have acquired this property for 1 lakh. On the remaining amount you pay taxes. Is it fair on our part? Now what is the value of 1 lakh way back in 1971? As good as so many lakhs. If you have to convert the value of 1 lakh that you have invested in the year 1971, what the value is as on today, it runs into huge lakhs of rupees. So this is what is done with the help of cost inflation index. which is the basics for this is the consumer price index. So this is given to us by the central government. Official gadget every financial year, they will be coming out with the index value. Now with the help of this, now my grandmother having sold this property, she doesn't have to pay on the difference of the amount. She has to pay taxes on the difference between her net consideration and indexed cost of acquisition. So how do I assess an index cost of acquisition? Cost of acquisition into cost inflation index of year of sale divided by cost inflation index of year of purchase. So the value of 1 lakh on the day of 1971 is brought to the value of 2020. Thereby my grandmother will be saving so many lakhs by way of taxes. Therefore, indexation is very, very important. With a gap of 1 month, see, a short-term capital asset may become a long-term may become a short-term. So be very, very careful when you are calculating this. Okay, and all depreciating assets are short-term capital assets. The changes that are incorporated by the bill this year is, in terms of section 54, 54 is a deduction which is available to a person who has disposed of his long-term house property which he was using for his purposes. He is disposing of and he is investing the proceeds in the purchase of another house property. Whatever amount is invested by him, he or she can get a benefit under section 54. Unutilized amount may also be deposited in the capital gain deposit scheme. Both the amounts will be allowed to as a deduction. But the rule is you should not be having more than one house properties. So the change they have brought into this section this year is you can have, already you are having one property, I am disposing of another house property and making investment in another house property, I am entitled to claim benefit for this house property also under section 54, provided the value of that house is not exceeding 2 crores of rupees. Okay, and the equity shares or the mutual funds I am selling, if it is shorter, that is the period of holding is less than 12 months, I have to pay a short-term capital gain tax rate of 15%, and if it is a long-term capital gain, I have to pay at 10%. It is apart from your slab rates 5, 10, 20 or 30. Other than that, you have to be paying these taxes. Now, the last head of income, all the incomes which are not accommodated by the first 4 heads of income are dumped into this head of income, that is income from other sources. All my interest incomes, dividends incomes, my fees, directors fees, etc., the royalties I am receiving, then subletting of the properties, national savings certificates, post office certificates, any interest income that I am getting, everything is brought to taxation under this. Friends, here I just wanted to focus on one important aspect, that is, what about the expenses? The expenses that you are earning, that you are incurring on those incomes which you are earning, the expenditure is related to the income, excepting in the cases of casual gains like your winnings from horse races or the lotteries, card games, etc. I am borrowing funds to make an investment in the debentures. Okay, then I am getting a debenture interest of 1 lakh of rupees. I am paying an interest of 20,000 rupees on the loan taken. This interest that I am paying to the extent of 20,000 will be directly allowed as deduction out of this 1 lakh. The remaining amount only is taxable. If expenses are incurred by me and they are directly related to this particular income, then whatever income, whatever expenses I am incurring, I can claim the benefit as deductions. But these deductions are not applicable on casual gains. Then I just want to talk about 2 important things about gifts. Friends, gifts is one important aspect of income from other sources. Income tax act, just think a wild imagination I'll throw. A country like India, where we are all basically culturalistic, ritualistic, etc. The traditional mindset, the huge amounts we are throwing lavishly for performing marriages and functions, etc. If income tax were to make it compulsory and they have one of their offices placed in our marriage pandals or the reception places with a record on their hand, every gift that you are receiving is subject to your tax. Mind you, it runs into huge amounts. But thank God, they have spared us from this. Nirmala Sitharaman also did not get this thought, because gifts on the ceremonious occasions, gifts from your relatives, blood relations, are not subjected to taxation. My father loves me like anything. He gives me some gifts. It is not taxable. The gifts I receive from my spouse are not taxable. The gifts I receive at the time of my marriage or a housewarming ceremony are not taxable. But gifts I receive from my friends, gifts I receive from my employer is taxable. Any cash gift that I am receiving more than 50,000 rupees, it is subjected to tax. And any kind gift that I am receiving of immovable properties, I have to take into account the stamp duty. If the stamp duty is less than 50,000 rupees, whatever is the stamp duty, that stamp duty is taxable in my hands, because I am receiving an immovable property as a gift without payment of taxes. If I am receiving any immovable property for inadequate consideration, where stamp duty exceeds at 50,000, the difference between stamp duty and that consideration, that balance of amount will be the amount of tax that has to be paid by me. If any other property I am receiving other than immovable property like jewelry, etc., and fair market value is exceeding 50,000 rupees, I have to pay taxes on the fair market value. If I am getting for any consideration and fair market value is exceeding 50,000, fair market value minus consideration, I have to pay taxes. Thank you, my dear friends. 3:29 sharp, I am stopping my lecture. Thank you very much, organizers and all the participants, for I do not know whether it is patient listening or careful listening. I thank you all for your participation, at least in numbers. Thank you, madam. Over to Roja, ma'am.
Thank you for such brief informative explanation, ma'am. Your examples and their explanations made it more easy for us to understand. Thank you so much, ma'am, once again.
My pleasure.
Very nice presentation, ma'am.
Thank you, sir. Thank you.
Now,
Thank you, Bhavani ma'am, for accepting our invitation and for being with us. And I can understand, how challenging it was to, what we teach in 1 year.
Yeah.
You could present it in 1.5 hours. The gist you could present in 1.5 hours. So I can very well understand your grievance.
Yeah.
But we were totally helpless.
Well, it's a sweet grievance, frankly speaking.
Thank
it's
you
a
so
challenge
much.
to me as a teacher too.
Yeah, thank you so much, ma'am.
Thank you, Sandhya ma'am. Thanks.
Madam, please stop your screen sharing, ma'am.
Yeah. I'm also stopping my video.
thank you, ma'am.
Yeah. Thank you. Thank you, one and all.
Yeah, dear participants, once again, good evening. Now we continue with the second session on set off and carry forward of losses and aggregation of income, which is to be presented by Dr. B. Sandhyarani ma'am. Sandhyarani ma'am, he is an assistant professor in commerce at University College for Commerce and Business Management, Usmania University, Hyderabad. She qualified SLET and completed her PhD from Usmania University in 2009. She has put in 20 years of teaching experience. Her areas of specialization include accounting and tax finance. She is recipient of Best Business Academic of the Year Gold Medal for the best paper presented at the 61st All India Commerce Conference held at Nagpur 2008. And she also received cash prize award for the best paper presentation at first annual conference of Telangana Commerce Association 2018. Ma'am has organized 6 workshops and seminars in different capacities, delivered lecture on various topics, has resource person in workshops and seminars. Under her guidance, 5 PhD research scholars are pursuing PhD, and I am grateful and thankful to be one of them. Now I would like to request Dr. Sandhyarani ma'am to take over the session. Thank you, ma'am.
Thank you, Roja, for introducing me to the audience. One second. Venkatesh. Yeah, 1 second. Yeah. Welcome back to all the participants to the second day of the National Workshop on Financial Literacy on Income Tax and GST. So with this, we have completed 4 sessions, yesterday 3 sessions, and then today in the morning, 1 session on all the 5 heads of income. Yes, it is really challenging to cover up all the 5 heads of income in 1.5 hour session. So therefore, I could understand how much, Bhavani madam must have struggled to think over what to communicate, what not to communicate, what to delete, what to omit, what to include in her presentation. I can very well understand about that. So my presentation begins from here after the 4th session, which is on set off and carry forward of losses. So I know we cannot interact, but what is the income? Under the Income Tax Act, nowhere the word income has been defined. Nowhere in the Income Tax Act, the word income has been defined, right? But there is an explanation. Lot is being explained about the word income, features of income. Income should have a source, income should be regular in nature. There are many features which are explained about the income. So this income can be classified into 2 types. It can be classified into 2 types. What are they? Agricultural income and then non-agricultural income. As you all are aware, agricultural income is exempt from tax under section 10 subsection 1 of the Income Tax Act 1961, right? And there is a definition for the word agricultural income. As per section 2 subsection 1A of the Income Tax Act, agricultural income is being defined. I'm not going into those details, right? But what is a non-agricultural income? As such, there is no definition given for the word non-agricultural income. Any income which is not agricultural income can be classified, can be taken as a non-agricultural income. So all this non-agricultural income is being classified into 5 heads of income. That is what Bhavani madam in the previous class has discussed, right? All the 5 heads of income, that is income from salary, income from house property, income from business or profession, income from capital gain, income from other sources. So when do we include income under a particular head of income? When do we include under salary or house property or any other head of income? We have set of rules, we have set of conditions. For example, to include income under the head income from salary, the condition to be satisfied is SSC should be the relationship between the receiver and the giver, it should be of the employer and employee, right? If that, which is equivalent to object of the master and servant, if that relationship is satisfied, then all the income which is received by the receiver can be taken under the head income from salary. Similarly, when do we include income under the head income from house property? SSC should be the owner of the house property. He should be the owner of the house property, and the land should consist of some construction. Only then, if the property has got inherent potential to generate income, then all such income can be taken under the head income from house property. Like that, to include income under a particular head of income, we have few conditions, right? So based on the satisfaction of those conditions, the incomes are taken under the respective heads of incomes. Okay, right. So, which was, I think, which was discussed in a gist of all the 5 heads of income was provided by Bhavani madam in the previous session. So, my job is to take it forward, from where she has stopped, right? So, that is set off and carry forward of losses. Let me share my screen. Am I audible?
Yes, ma'am, audible.
Okay. So the topic of the session is aggregation of income and set off and carry forward of losses. Okay, all right. So profits and losses, they are like, 2 sides of the coin. It is very hard, it is very difficult to digest the losses. But under the Income Tax Act, a relief is provided. A relief, a kind of a relief is provided, whereas the losses can be adjusted, right? We have the provisions of set off and carry forward of losses where the losses can be adjusted, right? So that is what is the topic of set off and carry forward of losses. Now, what is set off of losses? How do you define, what do you mean by set off of losses? There is a loss from one source. This loss, you can set it off against the income from other source. Right? Loss from one.
వెంకటేష్ గారు, హలో సార్. వెంకటేష్ గారు, హలో హలో వెంకటేష్ గారు, ఈ అనోటేషన్స్ క్లియర్ చేయండి సార్. అక్కడ మ్యూట్ చేయండి అనోటేషన్స్ ని. స్క్రీన్ షేర్ పక్కకు ఒకటి ఉంటుంది చూడండి,
ఓకే ఓకే సార్.
దాంట్లోకి వెళ్ళండి. అందులో మ్యూట్ అనోటేషన్ ఉంటుంది. స్క్రీన్ షేర్ లోకి వెళ్ళండి. స్క్రీన్ షేర్ పక్కకు చూసారా? మీరు స్క్రీన్ షేర్ చూసారా?
లేదు సార్, ఇక్కడ లేదు.
ఆ పక్కన ఒకటి ఉంటుంది చూడండి.
సంధ్య మేడం ఈజ్ హోస్ట్.
యు ఆర్ ద హోస్ట్. యు కెన్ ఆల్సో మీరు కూడా హోస్టే కదా?
ఐఎమ్ కో హోస్ట్.
మేడం
చెప్పండి.
మేడం షేర్ స్క్రీన్ పక్కకు ఒకటి ఉంటుంది చూడండి, ఒక ఐకాన్ ఉంటుంది చూడండి. దాన్ని క్లిక్ చేస్తే మ్యూట్ అనోటేషన్స్ అని వస్తుంది చూడండి.
Just checking. We have annotate.
No, annotate లోకి వెళ్ళండి. అది క్లిక్ చేయండి మేడం. Annotate.
Yeah, annotate.
Mute annotate.
We have mouse, select, text, draw, stamp, spotlight, eraser, format, undo, redo, clear, save. These are the options we have.
Ma'am, more is there. Ma'am, more options are there.
More. Let me check. Yeah, we have
click
more.
Click more and then in more you will find out, ma'am.
Disable annotation for others. That's yeah. Thank you so much. Thank you so much for helping me. We are learning. See, this is a process of learning. Thank you so much.
We are also learning.
And also, dear participants, first session attendance is posted in chat box. Please give attendance.
Yeah, so we were discussing about the set off of losses. So let us say, there is from a particular source there is a loss, and from other source there is a gain, there is an income, right? So the loss from one source can be set off against the income from other source. So this is the concept of set off of losses, right? So loss from one source can be set off against the income from other source. Then we call this concept as a set off of losses. Set off of losses can be of two types. It can be of two types: intra-head set off of losses and then inter-head set off of losses. So what is intra-head set off of losses? Why is the screen not moving? Okay. Intra-head set off of losses within the same head, right? If you're setting off the loss within the same head from one source to other source, then we call it as an intra-head set off of losses. For example, let us say, for example, business A has a loss and business B has a profit. So loss from business A, if it is set off against the profit from business B, then we call such a set off as intra-head set off. So within the same head, income from business, loss from one source, we are setting it off against the income from other source. Right, so let us see all the 5 heads of income, how the set off can be done. So hope you all have understood intra-head, that is within the same head, right? Within the same head, from one source there is a loss and from the other source there is a profit, right? When this loss from one source is set off against the income from other source, we call it as a intra-head adjustment, right? Now in the case of salary, can there be any loss in the case of salary? There can be zero income, nil salary, or otherwise a positive salary, a positive figure, right? But there cannot be any negative salary, negative income in the case of salary. So the question of the intra-head adjustments, inter-head adjustments, or the carry forward of losses does not arise in the case of salary income. Now the next head of income is house property. Can there be any loss in the case of house property? Yes. In the case of, let us say, let out house property, let out house property. Suppose if the loan if the loan is borrowed for the purpose of construction or for the purpose of purchase of the house property, and interest is payable on such a loan, and interest is exceeding over and above the income earned. If it is over and above, if it is over and above the income earned from house property, then there can be a loss from let out house property. Similarly, in the case of a self-occupied house property, also you can get a loss, right? Usually we take the net annual value of the self-occupied house property as nil, right? But if there is any interest payable on loan borrowed for the purpose of construction or purchase of the self-occupied house property, you can take it as a deduction. You can claim it as a deduction under section 24, right? So if you're claiming a deduction and showing the income as nil, it will result in loss from house property. Now this loss from house property, let's say there are two houses. There are two houses. House A, there is a income, and house B, there is a loss. Okay, so from house A, from house A, there is income. The income can be used for setting off the loss of house B. So within the same head, income from house property, adjustment is done between A and B of the loss and gain, loss and income, right? So this kind of an adjustment is called as a intra-head adjustment. So within the same head, from one house to other house, adjustments are allowed. In the case of the business, yes, an SSC can have more than one business, and one business there can be a gain, there can be profits, and from the other business there can be losses. So from one source to other source, adjustment is allowed with subject to few restrictions. And what are those restrictions? We will know in the next slide. Right, but within the same head, loss from one business can be set off against the income from other business. That kind of an adjustment is allowed. Now, in the case of capital gain, similarly, even in the case of capital gain, adjustment is allowed. Loss from one capital asset can be adjusted against gain from other capital asset, again subject to restrictions. There are restrictions which we will discuss in the next slide. Right, and then even the last head of income from other sources. If there is a loss from one source under the head income from other source and income from other source, it can be adjusted. Right, so what are those restrictions in the case of intra-head adjustments? Let us observe. Let us see. Now, we were talking about salaries. In the case of salary, there can be either income or otherwise nil income. So the question of the negative income or set off and carry forward of losses, the concept does not arise in the case of salary, right? As I said, house property, yes, from one house to other house, adjustment is allowed. Now, when it comes to business, we can classify the business into two types: speculative business and then regular business, non-speculative business. Non-speculative business is the regular business, right? So in the case of what is a speculative business? A speculative business is a business where, with a hope of making gain, with a hope of earning profits, you make an investment. For example, today you are purchasing gold when the cost of the gold is 51,000. Right, with the hope that in the summer very soon, in short period of time, maybe in 3 to 4 months, during the marriage season, the cost of the gold may go up to 55,000. So with the hope that it may go up to 55,000, when it is 51,000, you're making an investment in gold. So that is a speculation. You're hoping that it will increase, it will go up. Similarly, making an investment in shares. Right, today you're buying for 10 rupees, expecting that tomorrow it will go up to 11 rupees. Right, so with the hope of earning a gain within a short period of time, you're making an investment. You can call it as a speculative business. Right, so and what is a non-speculative business? The regular course of business which is carried out by an SSC can be called as a non-speculative business. Right, there are few restrictions in the case of intra-head adjustments with regard to set off of losses. In the case of the speculative losses, if there are any speculative losses, the speculative losses must be set off only against the speculative incomes. Speculative losses must be set off only against the speculative gains. They cannot be set off against the non-speculative profits. Okay, but whereas the non-speculative losses can be set off against the non-speculative profits, and also they can be set off against the speculative gains. Okay, so speculative to speculative adjustment is allowed. Speculative loss to speculative profit, speculative loss to speculative gain adjustment is allowed. Speculative loss to non-speculative gain or profit adjustment is not allowed. On the other hand, non-speculative loss to speculative gain adjustment is allowed. Non-speculative business loss to non-speculative business profits, even that adjustment is also allowed. Okay, so you have to remember here the restriction is there in the case of speculative business loss. Speculative business losses can be set off only against the speculative business gains, whereas the non-speculative business losses can be set off against the non-speculative business incomes as well as the speculative business gains. Right? Now the second point is in the case of other sources, race horses. If there is any loss from an activity of owning and maintaining race horses, right, then it can be set off only against the profit from the same activity. It cannot be set off against any other activity, any other gain, right? Within the same head, see, horse races, winnings from card games, puzzles, or whatever it is, horse races and all, they all come under, they all are casual income. They all are casual income, right? They are taxable under which head of income? They are taxable under the head income from other sources. Okay, so if there is a loss on owning and maintaining the race horses, this loss must be set off. It is allowed to be set off only against profit from the same activity, profit from maintaining and owning the race horses. Okay, it cannot be set off against other source of income within the same head. Within the same head, if there is a director's sitting fees is the income which is taxable under the head income from other sources. So this loss from race horses cannot be set off against the director's sitting fees. Or there is income from interest on securities. Right, so loss from race horses cannot be set off against the interest on securities. Okay, it must be set off only against profit from owning and maintaining of race horses. So this is a restriction which is there within the same head. Within this intra-head adjustment, these are the exceptions with restrictions. Now when we come to the capital gains can be classified into two types: long-term capital gain and then short-term capital gain. Any asset which is held for a period of exceeding 3 years is long-term capital asset. If it is held by the assessee for a period less than 3 years, then it is a short-term capital asset, right? So in the case of long-term capital loss, there is a restriction. Long-term capital losses must be set off only against the long-term capital gains. They cannot be set off within the same head against the short-term capital gains. Okay, right? I'll repeat the point. We classify the capital gains into two types: short-term capital gains, long-term capital gains. Okay, short-term capital losses, if there are any short-term capital losses, these short-term capital losses, they can be set off against the short-term capital gains. They can be even set off against the long-term capital gains. Both can be used. Long-term capital gains and the short-term capital gains, both can be used for setting off the short-term capital losses. But in the case of long-term capital losses, there is a restriction. Long-term capital losses must be set off only against the long-term capital gains. Short-term capital gains cannot be used for setting off the long-term capital losses. This is the restriction which is there within the same head in the case of intra-head set off of losses. Now moving on to the next point, that is a specified business, losses from specified business. Specified business is a business which is mainly established for the purpose of, storage of the agricultural produce. It is established for storing the agricultural produce. So such businesses, deductions are allowed under Section 35 AD. Special deductions are allowed under Section 35 AD, and such business, because they are claiming deduction under 35 AD, they cannot claim any other deductions under 80. That is point number 1. Now, in the case if there are any losses from a specified business, then these losses must be set off only against profit from other specified business. They cannot be, other business income cannot be used. Other business income or professional income cannot be used for setting off such specified business loss. Okay, so this was the point relating to specified business loss. Now, moving on to the interhead set off of losses. What is interhead set off of losses? Hope I made the point clear. Intra-head set off of losses. Intra-head set off of losses is within the same head. From one source, there is a loss. From other source, there is an income. So loss from one source can be set off against the income from other source. Okay, with a few restrictions and exceptions, which we have discussed in the previous slide. Now, moving on to the next one, that is interhead set off of losses. Interhead set off of losses, that is between the heads, set off of losses between the heads. Now, for example, we have a loss from house property, and there is an income from salary. Let's say there is an income from salary and there is a loss from house property, right? And within the same head, after the adjustment of the interhead adjustments, still there is a loss under the head income from house property. So this loss from house property can be set off. It can be set off against the salary income. Okay, salary is a separate head of income and house property is a separate head of income. Both are two different heads, right? But here the house property loss is set off against the salary income. So from one head to other head, the losses are being adjusted, right? So this concept is called as interhead set off of losses. Okay, right? So this adjustment is done only after doing the intra-head adjustments. Okay, only for adjusting the remaining losses against the income from other heads. Okay, right? So now let us see how the interhead adjustments can be done. Now, as I said, salary, the question of the set off of losses or carry forward of losses does not arise in the case of salary, because either you can have a nil income, either you can have a positive income or no income, that is nil. Income under the head income from salary could be nil or a positive income. The question of the negative income doesn't arise. Okay, so interhead adjustments will not be applicable for salary income. So the second head of income is income from house property. In the case of house property, after the intra-head adjustment, still there is a loss from house property. So loss from house property, it can be set off against income under any other head. Okay, we have other four heads of incomes like salary, business and profession, capital gain, and other sources. So other four heads of incomes can be used for setting off the house property loss without any restrictions. Without any restrictions, it can be, the adjustment can be done. Okay, now the next one is business loss, right? Again, under business loss, with an exception of the speculative business loss. Speculative business loss can be set off only against the speculative business income. It cannot be set off against any other head of income, or within the same head, it cannot be set off against the non-speculative business income. Okay, but otherwise the non-speculative business loss, right, it can be set off against other heads of incomes except salary. Except salary. Apart from business and profession head, we have other four heads of incomes. Except salary, leaving salary, the other three heads of income, that is capital gain, other sources, house property gain incomes can be used. That can be used for setting off the business loss. Okay, but again there is an exception. Speculative business losses. Speculative business losses cannot be set off against other heads of incomes. That is an exception. That is a restriction with regard to the speculative business loss. Okay, right? Then when we look at the capital losses. Capital losses, two types of capital losses, short-term capital loss and then long-term capital loss. Both the capital losses, whether it is a short-term capital loss or a long-term capital loss, that cannot be set off against the other heads of incomes. Okay, it must be set off only within the same head. Again, within the same head also there is a restriction for long-term capital loss. Okay, now between the different heads, adjusting the loss with the income of the other heads is not allowed in the case of capital capital loss. Okay, so capital losses, only intra-head adjustments are allowed. Inter-head adjustment is not allowed in the case of whether it is a short-term capital loss or a long-term capital loss. No inter-head adjustments are allowed. Now moving on to the activity of loss from activity of owning and maintaining race horses. Right, so even in this case, in the case of this particular loss, interhead adjustment is not allowed. Loss of activity of owning and maintaining race horses cannot be adjusted against income from other heads. It cannot be adjusted against the income from other heads. It cannot be adjusted against salary income or business or professional income or house property income or capital gain income, right? It cannot be used for setting off the loss relating to the activity of owning and maintaining race horses. Okay, so these are with these restrictions, the interhead adjustments can be allowed. Now let us see a small example based on those rules. Before we move on to this example, let me very briefly once again, touch upon what we have discussed till now. Set off of losses, that is loss from one source. If it is allowed to be set off against the income from other source, this concept we call it as a set off of losses. Set off of losses are of two types. What are they? Intra-head set off of losses and inter-head set off of losses. What are intra-head set off of losses? Within the same head, when loss from one source is allowed to set off against the income from other source within the same head, it is a case of intra-head adjustment. What is inter-head set off of losses? Setting off of the losses between the different heads, then we call it as a inter-head adjustments, right? In the case of the intra-head adjustments, salary will not have neither the inter-head adjustments or intra-head adjustments or carry forward of loss adjustments will not be there for the head salary, but for the house property, yes, within the same head adjustments can be done. Between the heads, losses can be adjusted. In the case of business, we can classify into two types of business income, right? Speculative, non-speculative. Speculative losses can be adjusted only against the speculative incomes, speculative gains, but they cannot be adjusted against the non-speculative profits. They cannot be adjusted against other heads of incomes. In the case of non-speculative losses, they can be adjusted against the non-speculative profits. They can be adjusted against the speculative gains. They can be adjusted against the other heads of incomes except salary. Except salary. In the case of capital gain, short-term capital gain, long-term capital gain. If there is a short-term capital loss to short-term capital gain, adjustment is allowed. Short-term capital loss to long-term capital gain, adjustment is allowed. Setting off of loss is allowed. Okay, right? Long-term capital loss to long-term capital gain, setting off of loss is allowed. Long-term capital loss to short-term capital gain, adjustment is not allowed. Similarly, whether it is a short-term capital loss or a long-term capital loss, this loss under the head income from capital gain cannot be set off against the other heads of incomes. In the case of other sources, one source to other source, setting off of losses is allowed, but in the case of owning and maintaining of race horses, within that loss can be set off only against profit from owning and maintaining of race horses. Okay, so this was the interhead and then intrahead adjustment of losses. So let us see a small illustration. Yeah, so here is my spotlight visible, ma? Yeah.
Yes, visible, madam.
It's visible? Okay. Yeah, so income from salary 4 lakhs. Income from salary 4 lakhs. Loss from self-occupied house property income. How do we compute the total income? Now, income from salary, it's a positive figure, 4 lakhs. Now, loss from self-occupied house property, it is a loss of 70,000. This can be set off. This can be adjusted against 4 lakhs. Okay, this can be deducted from the salary income. So 4 lakhs minus 70,000 would be 3 lakh 30,000. Then there is a business loss to the extent of 1 lakh. It is taken as it is. Business loss cannot be set off against salary income. Okay, so there is a restriction. Business losses cannot be set off against the salary income. So therefore, this 3 lakh 30,000 cannot be used for setting off this 1 lakh. Then we have one more income, that is the bank interest, that is the interest received on fixed deposit to the extent of 80,000. This 80,000 can be used. This 80,000 can be used for setting off this business income, business loss. Okay, loss is 1 lakh, but the income is 80,000. So to the extent of 80,000, it can be set off, and still there is a loss of 20,000. So business loss to be carried forward. Business loss to be carried forward is to the extent of 20,000. Okay, so what is the total income? 3 lakh 30,000. That is income from salary. After doing all this interhead and the intrahead adjustments, there is a income of 3 lakh 30,000. Hope you all have understood this. Okay, so house property loss is set off against the salary income. Business loss is not set off against the salary income, but business loss can be set off against the other source income. Okay, in spite of adjusting, there is a loss to the extent of 20,000. This is a business loss. So this needs to be carried forward to the next subsequent assessment years. Okay, now let us see the next illustration. Yeah. So here you can see that income from salary is 45,000. Income from house property is the negative income. If it is in the bracket, it means it's a negative income. So income from house property is 24,000 minus 24,000. Income from business, non-speculative, minus 22,000. Income from speculative business is minus 4,000. Short-term capital gain is minus 25,000. Long-term capital gain is 19,000. It's a positive income. Okay, so let us say, this is what is the details given for us. Then how do we compute the taxable income? Right, so income from salary is a positive figure, 45,000, and then there is a loss from house property. So loss from house property is to the extent of 24,000. So from salary income, 24,000 can be set off, can be adjusted. So 45,000 minus 24,000 would be 21,000. Okay, so income from salary still is 21,000. Now, after that, we have income from business, non-speculative, it's a loss, 22,000. So 22,000 as it is, we've taken, it cannot be adjusted from salary. So therefore, it's a loss of 22,000. Then we have a income from speculative business. Again, this is a loss of 4,000. Okay, so this loss, speculative business loss, can be set off only against speculative business gain. There is no such speculative business gain. So it can be carried forward. It's a loss for the year. Similarly, business loss also, it's a loss for the year. Okay. Now let us move on. Short-term capital gain. It's a loss of 25,000. So short-term capital loss, it's a loss of 25,000. But it is provided that it is given that long-term capital gain is 19,000. So available gain is 19,000, but short-term capital loss is 25,000. So to the extent of 25,000, the loss can be adjusted, and the remaining unadjusted loss, 6,000, is short-term capital loss. It can be carried forward. It is unadjusted loss for the year, for the current year, which can be carried forward. Okay, so this is another illustration to explain you how interhead and then intrahead adjustments are done. Now we move on to the next topic, that is carry forward of losses. What are the rules relating to carry forward of losses? Okay, we've discussed about interhead adjustments, intrahead adjustments, and then now we move on to carry forward of losses. As I said, in the case of the salary, no negative income, either positive income or otherwise nil, no income at all. But there's a possibility that there is no income at all, but there cannot be any negative income. Now, the second head of income, that is house property. Yes, there can be losses under the head income from house property in spite of doing intra-head adjustments and inter-head adjustments, that is setting off of losses within the same head and between the different heads. In spite of doing all those adjustments, still there is a loss under the head income from house property. Then such a loss can be carried forward. It can be carried forward to the subsequent assessment years. How long it can be carried forward? It can be carried forward for 8 subsequent assessment years. And in the subsequent assessment years, when it is brought down, it should be set off. It should be adjusted only against income from house property. Okay, this year there is a loss of 10,000. You can take it to the next year. Next year, when you bring it down, right, so from which source you can adjust that loss? Only from house property. It should be set off only against income from house property. Okay, so like that, how long you can carry it forward? You can carry it forward for 8 subsequent assessment years. 8 years it can be carried forward. Okay, right? Then the next one is the loss from the non-speculative business. That is a regular course of business. If there is a loss, in spite of doing the interhead and the intrahead and the interhead adjustments, still there is a loss. Still there is a business loss. Then even that business loss can be carried forward to how many years? Same is the rule. 8 assessment years. It can be carried forward for 8 subsequent assessment years. Okay, but in the subsequent assessment years, the brought down non-speculative business loss must be set off only against the head income from business or profession. Other heads of incomes cannot be used. Other heads of incomes, even there are gains, there are profits, there are incomes that cannot be used for setting off the loss from business. The brought down loss from business cannot be set off against other heads of incomes. It must be set off only against income from business or profession. Okay, and at the time, because it can be carried forward for 8 subsequent assessment years. So therefore, let us say, it was carried forward for 3 years and let us say in the 3rd year, the business was discontinued. It was discontinued and the loss is still not set off. It's okay, no problem. Until 8 years, still, even if it is discontinued before 8 years, still the loss can be carried forward and still it can be set off until it is adjusted. But maximum period is 8 years. Right? And one more condition to set off the brought forward business losses, the returns must be filed within the original due date. They must be filed within the original due date. If the returns are not filed, then this adjustment, this benefit cannot be, the setting off of loss cannot be claimed. Cannot be claimed. Okay. Now the next point is speculative business loss. Speculative business losses can be set off against the speculative business gains within the same head interhead between the different heads, adjustments are not allowed. And unadjusted speculative business loss in a particular year, it can be carried forward. It can be taken forward to 4 subsequent assessment years. It can be taken forward to 4 subsequent assessment years, and in the subsequent assessment years, when it is brought down, it should be set off only against speculative business gain. No other income can be used. No other income should be used for setting off such a speculative business loss. It must be set off only against the speculative business loss. So here, remember the point is that sorry for that. So here the point to be remembered is it can be carried forward for only 4 subsequent assessment years. In the case of house property, 8 years. In the case of non-speculative business, it is 8 years. But in the case of speculative business loss, it can be carried forward to only 4 subsequent assessment years. And again, the condition is, if the returns must be filed within the original due date. If no return is filed, then this benefit cannot, this sort of an adjustment is not allowed. Then same is the case, more or less, my explanation would be the same even for the remaining points, because the explanation is the same. Specified business loss. Specified business laws under section 35 AD. So if there are any specified business losses, if they are unadjusted specified business losses, they can be carried forward, right? And how long they can be carried forward? Until they are adjusted. There is no time limit. Okay, like, in the case of specified business loss, 4 years. In the case of non-specified business loss, it was 8 years. But in the case of non-speculative business loss, it was 8 years. In the case of speculative business loss, it was 4 years. But in the case of specified business loss, there is no limit. How long it can be carried forward? It can be carried forward until it is adjusted. Okay, right? So as long as it gets adjusted, it can be carried forward, and then even if the business is discontinued also, still it can be carried forward, and then it can be set off in future. And the only condition is the returns must have been filed within the original due date. Now, when it comes to the capital losses, whether it is a short-term capital loss or a long-term capital loss, unadjusted capital loss, after doing the interhead and the intrahead adjustments, the unadjusted capital losses, they can be carried forward to 8 subsequent assessment years. In the subsequent assessment years, long-term capital losses must be set off only against the long-term capital gains. Whereas the short-term capital losses, the brought down short-term capital losses can be set off against the long-term capital gain as well as the short-term capital gain. Both long-term as well as the short-term capital gain can be used for setting off the short-term capital gain. But other heads of incomes cannot be used for setting off the brought down capital losses. Condition is the same. Returns must have been filed within the due date. Now, when it comes to the race horses, owning and maintaining losses from owning and maintenance of the horse races, race horses, it can be carried forward, and adjusted losses can be carried forward for next 4 assessment years. And in the subsequent assessment years, they must be set off only against profits from owning and maintenance of race horses. No other income can be used for setting off such losses. Right, so these are the restrictions. With a few restrictions, adjustments can be done. Now, there are 2 points which you need to remember in the case of set off and carry forward of losses. The point number 1 is, suppose, a taxpayer is incurring a loss from a source, income from which is otherwise exempt. income from a particular source is exempt and there is a loss incurred from that source, then it cannot be set off against the profit from any taxable source of income. Okay, let us say for example, exempt income, you take one exempted income. If a particular income is exempt, I'm not getting the example right now, but if an income is exempt from tax, right, in the process of earning that income, let us say a loss is incurred. A loss is incurred. Now, this loss cannot be set off against other sources of incomes because it is basically an exempted income. That is the point number one. Now, the other point to be remembered is if there is a loss in the case of casual income, there is an uncertainty of earning income in the case of casual income, like crossword puzzles, winnings from lotteries, horse races, right, and then card games, bettings, and all these are the casual income. There is an element of uncertainty in earning the casual income. Cattle receipts, they are included under the head income from other sources. And if there is any loss, you were playing the card games and then you lost in the process of in the game you lost 10,000. Can you set off such a loss? Not allowed. It is a loss. It is to be taken as a loss of the SSC. You've invested in buying lottery, but you have not won any lottery. Okay, you have incurred the expense on buying the ticket. That expense you cannot claim it as a loss, or that expense cannot be set off against the other incomes. Okay, right? So any losses, if any losses are incurred in the case of the casual income, they cannot be set off against other heads of incomes. So these are the 2 points which you need to remember in the case of set off and carry forward of losses. And there is one more point as well in the case of business and profession, the order of set off. While setting off of losses in the case of business and profession, you need to follow an order while setting off of losses, right? So first of all, you have to deduct the current year's depreciation, then the brought forward business loss, right? And at the end, there are other brought forward family planning expenditure, and then scientific, any expenditure incurred towards the scientific activity, and all those, they are there. The order, there is a particular order which needs to be followed while setting off such losses or expenses. Now let us see an example, an illustration, to understand how this carry forward of losses are adjusted. Now here you can see short-term capital gain on sale of shares 1,50,000. There is a gain of 1,50,000 short-term capital gain. Long-term capital loss of the assessment year 18 to 19 is 96,000. This is a negative income and this is a positive income. Then short-term capital loss for the assessment year, that is previous year 1920, is 37,000. Negative minus bracket means negative income. Long-term capital gain, there is a positive income of 75,000. Okay, so how do we do this adjustment? How do we calculate the taxable income? So let us begin with the short-term capital gain on sale of shares 1,50,000. This is a positive income 1,50,000. Okay, right? And then there is a short-term capital loss of assessment year 19 to 20. Short-term capital losses can be adjusted against the short-term capital gains. Okay, let us first adjust the short-term capital losses against the short-term capital gains, right? So this 37,000 can be deducted from 1,50,000. So 150 minus 37,000 would be 1,13,000, right? Then later you take long-term capital gain given as 75,000. From there, you can deduct the brought down. 1819 ka long-term capital loss is to the extent of 26,000, right? But how much is the gain available? The gain available is 75,000, but the loss to be adjusted is 96,000. You cannot adjust whole 96,000, but you can adjust only to the extent of 75,000. And the remaining 21,000 can be taken forward, can be carried forward to the subsequent assessment year, right? So from 7, because the income available is less than the loss to be adjusted, only to the extent the income is available, it can be adjusted. So it would be nil. 75,000 minus 75,000 would be nil, and the remaining 21,000 long-term capital loss would be carried forward to the subsequent assessment year. So the taxable income would be 1,13,000. So this is one way of adjustment of capital losses. Now this is another illustration. Income from the activity of owning and maintaining the race horses. It is an income, 75,000. Income from textile business, 85,000. Brought forward textile business loss, 50,000. Brought forward loss from the activity of owning and maintaining the race horses relating to the assessment year 2017 to 18 is 96,000. This is a loss. This is a loss. This is a loss. Okay, let us see how do we do this set off and carry forward of loss. How do we do these adjustments? Now, let us first deal with the race horses. Income from the activity of owning and maintaining race horses, how much it is given? It is given as 75,000. So take 75,000. Here it is mentioned brought forward loss from the activity of owning and maintaining the race horses. So the losses pertaining to the assessment year 2017 to 18 is 96,000. Current year income pertaining to race horses 75,000. Losses on race horses pertaining to 17, 18, 96,000. So 17, 18 it can be carried forward for 4 years. 4 subsequent years it can be carried forward, right? So this year, that is the previous year, 19 to 20, it can be adjusted. Okay, it falls within the 4 years. So to what extent the loss can be adjusted? Income available is 75,000. Loss to be adjusted is 96,000. So only to the extent of 75,000, the loss can be adjusted. The remaining 21,000 is an unadjusted loss. This 21,000 unadjusted loss can be carried forward to the subsequent assessment year. Now, the next one is income from textile business. Income from the textile business is 85,000. And there is a brought forward textile business loss, right? Let us assume this is last year, right? So loss is 50,000. So from the current year business income, the brought down business loss can be deducted. From the current year business income, the brought forward business loss can be deducted. It can be adjusted. So 85,000 minus 50,000, if you deduct it, you get 35,000. So what is the total business income? It is 35,000. So this is how it can be adjusted. Excuse me. Now this is the last illustration. Yeah, if you see this illustration, I hope you all are able to catch the essence of the topic, set off and carry forward of losses. Now, let us see this example. Income from salaries 1,50,000. Income from speculation business 60,000. Loss from non-speculation business, it's loss 40,000. Short-term capital gain 80,000. Long-term capital loss of the assessment year 18 to 19. So previous to previous year loss 30,000, and then winning from lotteries is 20,000. So these are this is what is the information provided. So how do you do the adjustment? How do you set off and carry forward the losses? Let us begin with the income from salary. Income from salary 1,50,000 as it is, we take it. Then income from speculation business given in the problem as 60,000. Loss from non-speculation business is 40,000. Non-speculation business losses can be set off against the speculation business profits. Okay, non-speculative business losses, it can be set off against the speculative business gains. Right, so therefore, this 40,000 can be set off against 60,000. So still you have another 20,000 speculative business gain. right? Then short-term capital gain 80,000, take it as it is, and then long-term capital gain of the assessment year 2018 to 19 is 30,000 minus. Long-term capital losses can be set off only against long-term capital gains, and here there is no long-term capital gain pertaining to 1920 assessment year, right? So therefore, this long-term capital gain loss of assessment year 18-19, 30,000 can be carried forward. This can be carried forward, but it is an unadjusted loss. It cannot be set off against any other heads of incomes. Okay, then the last item, winnings from lotteries. It's a casual income to be taken under the head income from other sources. So winnings from lotteries is 20,000. Right? If you add up all the incomes, then you get 2,70,000 as the taxable income. So this is how we do the adjustment of set off and carry forward of losses. So any doubts? Let me see the chat box in case if you have any. I do not know whether you understood or not. Okay. Yeah, PPTs, I don't mind sharing it. I'll share it in the WhatsApp. There is no internet connection. I'm so much confused to set off business loss, depreciation of last year and current year, and intra-head adjustment. Okay, I can explain on that. Probably I can clear that point. See, in the case of the business income, while setting off of losses, you know, there is an order of preference to be followed, right? So if there is a business income, first of all, you have to deduct the current year depreciation. If there is a depreciation for the current year, that current year depreciation must be deducted from the business income. After deducting the current year depreciation, still the business income is positive, then you have to deduct the brought down, that is the last year's business loss. If there is any business loss of the last year, that should be brought down this year, and then it can be adjusted, it can be deducted. So brought down, the business loss can be set off against the current year available business income. Okay, right? So like that, you know, you can set it off, and sometimes, you know, it quite happens that, you know, let us say before taking the current year's depreciation, let's say the business income is 10,000. Before taking the current year's depreciation, the business income is 10,000, and the current year's depreciation, let me say it is 35,000. Business income is 10,000 before depreciation, and current year's depreciation is 25,000. So to the extent of only 10,000, you can set off the current year's depreciation, and the remaining 15,000 unadjusted depreciation, current year's unadjusted depreciation, you treat it as a business loss, or otherwise you can even take it as an unabsorbed depreciation. You can even treat it as an unabsorbed depreciation, and next year you can carry forward either as a business loss 15,000, or you carry it forward as an unabsorbed depreciation 15,000. There is an advantage of treating this item as an unabsorbed depreciation rather than taking it as a business loss. Reason being, if you take it as a business losses can be carried forward for only 8 subsequent assessment years. 8 subsequent assessment years. Within 8 years, if it is not adjusted, then it gets exhausted, it becomes your loss. But in the case of unabsorbed depreciation, you can carry it forward to the subsequent assessment years, and you can even, when you bring it down, you can set off against other heads of incomes as well. Unabsorbed depreciation, the last year's depreciation which was not absorbed, when you take it to the next year, we call it as a unabsorbed depreciation. So the brought forward unabsorbed depreciation can be set off against income from business or profession. If that income is not sufficient or not available, then an unabsorbed depreciation can also be set off against other heads of incomes. Otherwise, this is an exception. This is a special exception available to the, allowable to the unabsorbed depreciation. And even if other heads of incomes are not available to set off the unabsorbed depreciation, then it can be even carried forward. How long it can be carried forward? There is no limit. until it is absorbed. Until it is absorbed, the unabsorbed depreciation can be carried forward. So rather than treating it as a business income, business loss, it is always better to treat it as a unabsorbed depreciation, because treating it as an unabsorbed depreciation has a benefit over treating it as a business loss, right? So now the next almost we have another 3 to 4 slides to go. Aggregation of income, what do you mean by let me see the chat box. Yeah. Aggregation of income. So what is aggregation of income? Calculation of the total income. Okay, so how do we actually calculate the total income of an SSC, total income of an individual, right? While calculating the total income of an individual, all these incomes must be included. All these points must be taken into consideration while calculating the total income of an individual. The first one is income of the SSC. All the 5 heads of income. Just now you heard about all the 5 heads of incomes in the previous session. That is the income from salary, income from house property, income from capital gain, income from business or profession, income from other sources. All the 5 heads of incomes, must be computed. After computing all the 5 heads of incomes, set off and carry forward of losses adjustments must be done. After doing all those adjustments, in addition to that, the following transactions, the following incomes also must be considered, like deemed incomes, clubbing of incomes, and then the share of a member in the income of a AOP or BOI. All these also must be considered while calculating the total income of an SSC, right? So let us see what are deemed incomes. Income of the SSC, all the 5 heads of incomes was already dealt in the previous session. Now let us see what are these deemed incomes and why should we include them in the total income of the SSC, total income of the individual. Now, while calculating the total income, the following incomes will be deemed as the income of the SSC and they must be included in the total income of the SSC. Now let me first explain what are they and later I will explain you the concept, right? What are cash credits? If any cash credit amount in the books of accounts, if any credit is found and SSC is not in a position to explain the source of such a credit, where from he got that credit, the source of receiving such a credit, is not in a position to give an answer to that, right? You can call it as a cash credit under section 68. Let me explain the terms, then I'll tell you about the treatment. Then unexplained investments. Let us say an individual has purchased a land worth of 1 crore. He made an investment in land worth of 1 crore, right? And when he is questioned where from he got the money to make such a huge investment, he is not able to answer the source of such an investment. He's not able to he's not able to explain. Then we call it as a unexplained investments. Then unexplained money is found with the SSC, with the individual, and but what is the source, where from he got that money, he is not in a position to explain. Then we call it as an unexplained money. Then investment amount not fully disclosed in the books of accounts, only partially disclosed, not fully disclosed, right? When he's questioned with regard to the reasons, he's not in a position to answer, right? Unexplained expenditure. Similarly, let us say, he performed the marriage of his son by incurring an expense of 50 lakhs. So where from he got that 50 lakhs to spend for the marriage, for the event of marriage, where from he got the 50 lakhs, is not able to explain the source of such an expenditure, then you can call it as an unexplained expenditure, right? Similarly, amount borrowed or repaid on hundi. Hundi is a financial instrument. He's not able to, explain about that transaction, what for he has borrowed or how he had repaid that hundi amount. Is not able to answer, right? In all these cases, the explanation is the same, whether it is a cash credit or unexplained investments, unexplained money, or unexplained expenditure. In all these cases, right? If SSC is not able to provide a satisfactory answer to the assessing officer with regard to the source of such an expenditure or source of such an investment or source of such an income, he is not able to explain, or the explanation provided by the SSC is not up to the satisfaction of the assessing officer. The assessing officer is not convinced by his explanation. Then in both the cases, all these amounts will be considered. All these amounts will be deemed as the income of the SSC in the year in which such amounts are found. In which such amounts, investments or money or expenses were found, such transactions were found. Okay, and they need to be included in the total income of SSC. Okay, and how about the tax treatment for the deemed incomes? Whether it is under 68 or 69, 69A, 69B, C, D, whatever type of a transaction, whatever type of a deemed income it might be, the rate of tax to be levied on such deemed incomes is 30%. And similarly, the surcharge and cess also is applicable on deemed incomes. And on deemed incomes, no deductions are allowed. No set off and carry forward of losses. No such adjustments are allowed. No expenses can be set off. No set off and carry forward of losses. Such adjustments cannot be done in the case of deemed incomes. Okay, so first point is on the deemed incomes, the tax to be levied is 30%. And on such deemed income, no expenses are allowed to be deducted and no set off and carry forward of losses adjustments are allowed. Then the next one is clubbing of incomes. See, it quite happens that who likes to pay the tax? Who likes to pay the tax? Nobody. We all, everyone wants to pay as less as possible, as much less as possible, or otherwise, if possible, if we can avoid or evade, to avoid only, we all do the tax planning. We try to, know about all the exemptions, deductions, reliefs, rebates, and then claim all those exemptions and all, and do the tax planning, minimize our tax liability, so that, we pay less to our national exchequer, right? So nobody likes to pay the tax. It's an enforcement. It's an enforcement of law. It's forcibly levied by the government. So therefore, because it is mandatory, we cannot escape from paying. So therefore, we all pay it. So what do people do is, SSCs do is, they try to evade the tax in different ways. They try to evade the tax in different ways. So how can they evade the tax? What are the gimmicks they can follow to evade the tax? Let us say, for example, in a family, there are 4 members. Out of the 4 members, let us say only one family member is a earning person, and the remaining are not earning. And if the income of such an earning person is high, you all are aware of the progressive rates. In India, taxes are levied on progressive basis. 10%, 20%, 30%, as the case may be. As the income increases, rate of tax. Can I request the as the income increases, the rate of tax leviable on such income also increases. Isn't it? You all are aware, up to 2,50,000 is the exemption limit, up to 5 lakhs is 5%, and 5 to 10 lakhs is 20%, and 10 lakhs and above, the rate of tax leviable is 30%. And long-term capital gain flat rate of 20% is leviable. On casual income, 30% is the rate of tax leviable. On short-term capital gain, subject to security transaction tax. In shares, right, 15% is the rate of tax leviable. All these are the rates of taxes. As the income is increasing, the rate of taxes also is increasing, right? Suppose if only one person in the family is a bread earner, and if his income increases, obviously he'll have to pay more tax. more tax to the government. So what he can do is, because there are other 3 family members who are not earning, so he can transfer a part of his income in the name of other members of the family. Because every member can claim exemption to the extent basic exemption limit is 2,50,000, or 5%. Even if it exceeds 2,50,000 up to 5 lakhs, it is only 5%. So with an intention to evade the tax, with an intention to evade the tax, this person may transfer either the income or may transfer the income generating assets. Even the income generating assets may also be transferred in the name of the relatives or the family members, right? So that he will not be burdened with high rate of tax. He may be able to pay the tax at a lower rate. Quite possible, right? So all these are the gimmicks which may be played by the individuals in order to evade the tax. So these are some of the transactions, right? In all these transactions, how do we do the treatment? That is what let us discuss. And now the first point, transfer of income without transfer of assets. Here, the SSC is transferring, the transferor is transferring the income, he's transferring the income without transferring the asset. Asset is, the ownership of the asset is in the name of the SSC himself, but simply he's transferring the income in favor of Mr. A. Okay, right? Then that income is taxable in the hands of the transferor. The person who's transferring is called as a transferor. Okay, so such an income is taxable, is to be included in the total income of the transferor and not to be included in the total income of transferee. Right? Then point number 2, revocable transfer of assets. Sometimes some of them, what do is just before the filing of return, due date of filing of return, they transfer the asset, the income generating asset, they transfer it in favor of their relative or friends or their spouse. Okay, and immediately after the filing of the return, they take back the asset. They take back the asset. As on the date of filing of return, that asset will not be there in their name, but once this filing is done, they take it back. Okay, so this is the case of revocable transfer of assets. So any income generated from such assets which are revocable back to the SSC, right? All such incomes must be included in the total income of the transferor and not in the hands, they are not taxable in the hands of transferee, right? Then the third point, salary, commission, fees, or any other remuneration to the spouse. Right? If any kind of a remuneration, if it is paid to the spouse, if it is paid because of his or her professional expertise, if it is paid, then it is allowed as an expense. But otherwise, because is a spouse, while preparing the P&L account, if the remuneration is paid to the spouse and if it is debited to P&L account, debited to profit and loss account, obviously the profits will come down, right? But if that remuneration is paid to the spouse because of the professional expertise of the spouse, then it is allowed. It can be taken as an expense. Otherwise, this cannot be treated as a expense. It should be added back to profits. It should be taken in the total income of the SSC. Not allowed as an expense. Not allowed to be treated as an expense. Right? So the same are the nature of the transactions, nature of the expenses in the other cases, like income from assets transferred to spouse without receiving the adequate consideration. Here it is income from assets transferred to spouse. Only the income from the assets are transferred to the spouse, right? So without transferring the asset, only the income is transferred to the spouse. Not allowed. In the hands of the transferor only, such income is included in the total income of such SSC it will be included. Similarly, income from assets transferred to daughter-in-law. The asset is transferred to the daughter-in-law without receiving adequate consideration. Without receiving adequate consideration, the assets are transferred to the spouse or to the daughter-in-law or to a person or to association of persons or whoever it is. Transfer is done without receiving adequate consideration. Then any income generated from such an asset must be included in the total income of the transferor and not in the hands of transferee. Not in the hands of transferee, right? All these transactions are done purely to evade, that is to to minimize the tax liability, to evade the tax. Such transactions may be occurred, right? Then similarly, here we have a transaction called income of a minor child. Minor child cannot be deemed as a SSC as per the Income Tax Act 1961. Minor child cannot be considered as an SSC. But if such a minor child is earning income out of her own individual potential, then the income of such a minor child can be added in the total income of one of the parent whose income is the highest. Let us say father and mother, both of them are there, right? Let us say father is earning 10 lakhs per annum and then mother is earning 8 lakhs per annum, for example. Okay, and let us say the minor child is earning some 1 lakh per annum, right? So the income of the minor 1 lakh can be added to the income of whose income it should be added, because father's income is highest when compared to the mother's income. So this 1 lakh must be added to 10 lakhs, that is father's income, 10 lakhs, and then the father can claim a basic deduction of 1500. Even a deduction is allowed for including the minor's income in his income, in his total income. Okay, and also he can claim a deduction to the extent of 1500 when the income of a minor child is included in the total income of the parent. Okay, right? So this is how the treatment is to be given with regard to all these transactions, clubbing of incomes. So all these are the points which needs to be kept in mind while calculating the total income of a person, while calculating the total income of an SSC being individual here, right? In addition to that, sometimes an individual may be in the capacity of a member of association of person, or in the capacity of a member of body of individual, also may be getting his share of income from such AOP or BOI. Okay, right? So share of income received by the individual from AOP or BOI. How about that income? Do we include in the total income of the SSC or not? Total income of the individual or not? Okay, if AOP and BOI total income, if the income of the AOP and BOI, if it is taxed, then the share of the income which this individual is receiving, share of income which this individual is receiving becomes, it should not be included in the total income. It is already taxed taxed in the hands of AOP or BOI, right? So therefore, the share of the income which the individual is receiving from such a AOP or BOI, it should not be included in his total income. It should not be included in his total income. Okay, right? Otherwise, if it is not taxed, if AOP or BOI is not taxed, then the share of the income the individual is receiving from such AOP or BOI, it should be included in the total income. Okay, right? It should be included in the total income. So all these are the points which are to be kept in mind while calculating the total income of an individual, right? So after all these calculations, we will arrive at the gross total income. After calculating the gross total income, deductions are allowed under section 80. Deductions, right? So right from section 80C to 80U, there are many deductions which if an individual is eligible, can claim under the respective section. Okay, so we have a class on tax planning by Ravi sir. He will be discussing on all the deductions under 80C. So I'm not going to touch upon those deductions, but the procedure of computing the total income is, the procedure of computing the total income of an individual is, you got to calculate the taxable income under the head income from salary, taxable income under the head income from house property, under the head income from business or profession, then capital gain, then other sources. After calculating all these 5 heads of incomes, you got to do the set off and carry forward of losses adjustments. All these adjustments of the set off and carry forward of losses must be done. After then, all these, aggregation of income, the points which we have discussed about the deemed incomes, clubbing of incomes, and all those points also must be taken into consideration while calculating the gross total income. While calculating the gross total income. From the gross total income, all the 5 heads of incomes together, we call it as a gross total income. From the gross total income, deductions are allowed under section 80. As per the eligibility of an individual, he will claim the respective deductions under 80. Right? So gross total income less reductions under 80, the difference of the two would be called as the total income. Now, this total income, if it is exceeding the exemption limit for the current assessment year, the exemption limit is 2,50,000. If it is exceeding the exemption limit, then at slab rates, the rates of taxes are levied. Right, so 2,50,000 to 5 lakhs 5%, 5 lakhs to 10 lakhs it is 20%, and then if the income is exceeding 10 lakhs, then the rate of tax leviable is 30%. In the case of the long-term capital gain, it's a flat rate of 20%. Okay, casual income, it's a flat rate of 30%. In the case of short-term capital gain being shares subject to the security transaction tax, the rate of tax is 15%. So these are the normal rates of taxes which are to be applied on the total taxable income as the case may be and calculate the tax liability. Okay, but from this assessment year, that is on current year income, I mean, when you move on to the next year, right, when you calculate the income of this year, next year, this year will become the previous year. So next year, when you calculate the income of this year, there is a choice given. You must have already, read and then heard the budget presented by our finance minister. Right now there is a new rate and then the old rate, a choice is given. The choice can be exercised. Okay, whether the same old rates the individuals can apply, or otherwise as per the new rates also the rates of taxes can be applied and tax liability can be calculated. Okay, all right. And after calculating the tax liability, if any tax is paid in advance, if any taxes, especially in the case of the salaried employees, they pay the tax in advance, right? So if any tax is paid in advance, the advance tax must be deducted from the tax liability. In addition to the advance tax, if any tax is deducted at source, there are few cases. Now, next session, you have a next session on ETDS and then advance payment of tax, which will be discussed in detail by Patrick Sir, right? But if any tax is deducted at source, right, where in some few cases where, as and when the income is earned, tax is deducted. Usually, what is the golden rule? What is the golden rule for payment of tax? We pay the tax this year, we pay the tax on the income earned during previous year. Next year, we pay the tax on the income earned in this year. Okay, right? So this is the golden rule. We pay the tax on the income earned during the previous year. But there are few exceptions where, as and when the income is earned, tax is deducted at source, right? That is the concept of the tax deducted at source, and all that concepts and all will be discussed in detail by Patrick sir, right? So if there is any TDS, then from the tax liability, advance taxes must be deducted, TDS must be deducted, and finally we arrive at the tax payable by individual. That is the final figure of tax, if any, payable by the individual to the Department of Tax. Right, so with this, I come to the end of this session. I hope at least you could understand the gist of the points. Are there any questions? Okay. So I think, and even the time now is 4:56. Uh, the next session will begin at 5:10.
Yeah. Thank you, ma'am.
Yeah.
And thank you for your elaborating by explaining the topics with their respective illustrations, ma'am. They were really significant and accurate. Once again, thank you very much, ma'am.
Yeah. Thank you, Roja. Thank you, Roja. So I think the audience, yeah. You want to make an announcement, Roja?
No, 10 minutes break now, ma'am.
Yes. So now the time is 4:57. Participants can again come back by sharp by 5:10. I think Patrick sir must have already joined.
I'm there, ma'am, already there. I'm there.
Yeah. So, sir, shall we start, or otherwise shall we give a break?
No. I think it would be bad. Let us give them a small break, though.
Small break.
Ma'am.
Sir?
Hello, ma'am.
I think Venkatesh is conveying something.
Okay.
Madam, సార్ని close చేయండి మేడం. Patrick sir.
If I need to do the screen share, you need to make me the co-host.
Okay. 1 second.
Yeah. And make host as Roja ma'am is also.
Okay, 1 second. Let me check.
Sir, good evening, sir.
Hey, Venkatesh.
Sir, now you are host, sir.
Thank you.
Sir, no. Now you are host, sir. Host మీకు వచ్చేసింది.
Don't give me such big responsibilities, man. I'll fail short of fulfilling them.
మేడం బై మిస్టేక్ వచ్చినట్టుంది. నన్ను కానీ మేడం కానీ హోస్ట్ చేసాను సార్.
And Venkat, just check. I think now even people are not realizing. They are scribbling and they are annotating in between.
Okay, sir.
Yeah, ma'am, somebody has put a circle on all the slides.
Yes, sir.
The part of the participants. Sir.
So you can make an announcement, sir, Patrick, sir.
Yeah, I will.
Sir, make me host, sir.
Me?
You are host. Now you are host.
Right.
Make me host.
I don't know where the controls come.
Just click on my image, sir. There are 3 dots are there. Click on that.
Right.
Yeah. Right click.
What? Make host.
Yeah.
The host.
Yeah, sir. Okay. Thank you, sir.
Venkat.
Sir.
Just check if anybody is annotating. Just remove them from the group.
Thank you. Okay, sir.
Somebody annotates anything. Just remove them from the group already.
Yes, sir. I already deleted 4 members.
No, we are here for the serious ones.
Yes, sir.
Not serious, we don't need that.
Yes, sir. సార్ కొద్దిగా స్క్రీన్ బెండ్ చేసుకోండి సార్ మీరు. లిటిల్ బిట్. ఓకే, ఫైన్ సార్. ఫైన్. సూపర్ సార్. Okay, dear participants, we will join later with a short break. Attendance link will be shared after third session starts. Okay, the second session attendance will be given when third session starts. Sir, fan sound, sir.
No?
Patrick, sir. Yeah.
ఇప్పుడు వినిపించట్లేదుగా?
ఓకే సార్.
ఏం లే ఎవరో ఇది చాట్లో సెకండ్ సెషన్ది అటెండెన్స్ లీగ్ అడుగుతున్నారు, పెట్టారా?
లేదు సార్, మనం స్టార్ట్ అయిన తర్వాత పెడతాం సార్.
ఓకే, స్టార్ట్ అయిన తర్వాత పెడితే అది నింపుకుంటూ కూర్చుంటారు.
ఓకే సార్, పెడతాను సార్. రెడీ ఉంది. Dear participants, please check chat box. The second session attendance link will be posted. Is posted. Please check the chat box and complete the process immediately. So shall we start, sir?
Yeah, I'm ready.
Start this now, Venkatesh sir.
Okay, ma'am. Introduce about, sir.
Okay. Good evening, sir. Good evening, everyone. Here the start today's final session of today's workshop on ETDS and advance payment of tax is to be presented by Dr. A. Patrick sir. Since 2007, Dr. Patrick sir has been working as an assistant professor in the Department of Commerce, Usmania University College of Commerce and Business Management. Prior to this, For 2 years, sir has served at Arba Minch University, Ethiopia, East Africa, under the United Nations Development Project, as a lecturer in the Department of Management. He is an empanel member for NSIC as resource person. Patrick sir has attended several national and international seminars and presented papers. Sir's books on CRM, a direct exploration in Select Bank, was published in Germany by Lambert Publication. His areas of interest are marketing, general management, and quantitative techniques. Now I would like to request Dr. Patrick sir to take over the session. Thank you, sir.
Thank you so much. Thank you so much, Rojarani ma'am, for keeping my profile as brief as possible and giving me good amount of time that I can go about with getting into my conversation with the participants here in the session there. I thank the organizers and my colleague and good friend for long, Dr. Ravi and Dr. Sandhya ma'am, for giving me the opportunity to speak in this forum around. I had been through yesterday and today's sessions as well. I had gone about with listening to every person who spoke in the inaugural function. It got dragged a bit, but I felt it was a lot of value addition that had happened. I mean, I really appreciate the kind of hard work that was put by our controller. I think all of you all by now would know that which states stands the least when it comes for literacy with taxation, and which state had gone about with Venkat, yeah. Which state goes about with standing the best when it comes to literacy levels with tax? He said about Gujarat and Chhattisgarh there. And I really liked even our own registrar, Gopal Reddy sir, trying to say that it is needed by everyone, but he used one word. I mean, he comes from a physics faculty. The controller of exams and the person who is in charge for the RUSA, he is from the mechanical engineering department. They were talking about tax. There was one word a registrar used where he said the tax is a bit clumsy. It's very difficult to go about with understanding the language. And every time towards the end of the year, we have to run to a chartered accountant, and he goes about with figuring out as to how much is the tax liability and other things around there. And I would only request, I've seen the chat when ma'am was speaking, that is Dr. Sandhya. Somebody asked, can you explain it with a small numerical or something of that kind? I would just ask you, like, if you can go to the website, which is incometaxindia.gov.in. Let us say there is also a foreign student from Palestine who's attending the session in this group there, Ibrahim, I believe. Now,
Ibrahim, sir. Ibrahim.
Yeah, I know it. Now, I always tell it to students because year upon year, when I initially joined in the campus college, there were a lot of foreign students, who to be really baffled because head or tail of Indian tax system they don't understand, and they're asked to directly talk about tax planning as a paper in MCOM in the fourth semester. So the thing is, if you can visit this income tax website, what will happen is you would get to know about something called as FAQs. I really love the way Bhavani ma'am had initiated the talk today, where she said about the five heads. I grew a bit nostalgic when she was speaking. When I was working in Badruga College, I remember long ago, there I was a bit sulking when they said I should pay income tax and other things there. And the money was not big, but the tax rates and other things that was there. And I remember Mr. Bung, who was the chartered accountant, called me aside and said, "What happened? I can sort out something for you." I said, "This is the tax that I have to pay." Then, he said, "Why don't you claim HRA?" I said, I'm living with my parents. Then he asked, "Is your father working still?" I said, "He's retired." He said, "Why don't you do something? Like, are you taking care of your family expenses and other things?" I said, "Yes." Then he said, "Why don't you go about taking the rent bills from your father?" I said, "Rent and bills from my father? I'm staying in the house. I mean, I'm not a tenant or something, that I'm a son." He said, "This is permissible. Go ahead and do it. You're not doing anything wrong. This is what is tax planning." I could recollect that when our ma'am was saying, I came to know she was giving examples of four houses and everything to do with her son-in-laws and getting her daughters educated and all that stuff there. Very beautifully, she has explained to you about what is tax planning and other things. And maybe for a while, I heard even Sandhya ma'am speak about set off, carry forward, and clubbing and other things that are there. And I'm given this role to speak to you about what is this TDS. what is TCS, what is advanced tax. Maybe towards the end, I even speak little on the ETDS part of it, that is electronic filing of TDS part. And it's a nice way that it's been organized. I've heard Usha ma'am, that is a senior Usha ma'am. I remember a little over 20 years ago when I started my career of teaching at Badruga, M. Usha ma'am had organized a workshop for 3 days, FDP program at University College for Women. It was only on taxation. Mind you, there was very huge things, unlike the way things are getting simplified today as GST and other things. There's a lot of things under the direct and indirect taxes at that time. And 3 days we were exposed to different things. And listening to her yesterday was again getting memories of little over 20 years back when I attended a session. Very well she said about, I remember those words like samman for respect, where she said VDIS, voluntary disclosure of income scheme, and a lot of other things she spoke in yesterday's session, gave a lot of inputs about research. And maybe by then I had got back from the campus to get back home. And towards the end, I heard even our head of the department, that is, there are two Ushamans, right? That is another confusion that would have caused. The first two sessions were, after the inaugural was taken by M. Usha ma'am, and the last session was by uh, V. Usha Kiran ma'am. That's a professor HOD there. And she had gone about with trying to get into the details of all the terms and terminology used in tax. It was an exhaustive list I've seen there. I mean, she had left these things to Ravi sir probably to cover tomorrow as to what is the difference between tax management, tax evasion, tax avoidance, and tax planning. So my friend would be talking about it tomorrow. And I vividly remember around 7:30 odd when I was working it out with my phone. I'd seen ma'am talking about words like what is PAN, what is TDS, and what is TCS, and a lot of TAN and other things there she was discussing with you all. Now, with this kind of a thing there, I just want it to be reiterated again that to all the participants who are there, please, uh, somebody is saying in the chat, we didn't fill the third session attendance due to poor internet. Third session is my session. I think towards the end, they will put the attendance link. Don't be bothered about much. I mean, it's needed. It's important. I'm not undermining it. Without it, I don't think my friends are going to go about with issuing the certificates and other things. It's not just the issue of certificate that you have. I mean, I'm doing a lot of courses related with MOOC and other things that are there. And what I would request is the quest that you have for learning and draw the clarity when you listen. I think such kind of platforms are not provided again and again. So make the best out of the time that is there. Maybe later on they will release the links that are given on YouTube, but listening to it and re-listening again, and that's something which is going to help you out a lot. And it's been long that I've taught tax, but at Badruga, I remember a little over 8 years I've taught that. And in the beginning of the career for around about 6 or 7 years at the campus college. And I still have vivid memories of meeting Vinod K. Singhania sir when he had come for releasing some taxman publications and he gave a lecture here. So I would go about with reading that book a lot. Another thing for indirect taxes in the past, I used to depend a lot on Date, a book. The author is Date, Datey. And there are a lot of websites that are there which will help you out. Maybe Tax Guru is one. And I would request the participants, there are a lot of videos. Now, what I'm going to speak to you about TDS and what happens if you don't file your returns and other things there. I mean, I was just seeing a character who happened to be the coach of Dhoni in that movie on Dhoni there. I mean, he was there a part of that 20 minutes odd video, which was issued in public interest by the income tax authorities. Maybe later I will share those two links with Sandhya ma'am so that you can go through that videos and get a feel of the entire aspect of what I'm going to speak to you now in terms of what is this tax deducted at source. The other thing that I want you to go about doing is if you visit that income tax .gov.in, there's very beautiful notes that are there. You get tax book, that is an issue. Every year the book gets replaced because of the figures. And this year, let me tell you, a lot of changes were being brought by the finance minister. There's a huge confusion between what is this old regime and what is this new regime when it comes with somebody giving me a thumbs up. Thank you, Sandeep. So the thing is, what is this old regime and what is this new regime of taxation? Now, would I go about with the old regime, which allows me all the deductions and other things there? Or would I not claim that exemptions and deductions and just go about with filing my return without that? Believe me, one thing, all those who are listening to this session there, sooner or later in future, the government will slowly start easing away all the deductions. We always find it. I would wish that you read a book by Deepak Parag, not Parik. I said Deepak Parag, which is one of the first books which was written on what is known as behavioral finance in India. And he says if you buy a home on a home loan, you're creating an asset for the banker and not for yourself. You get it? Now, I've taken a loan of 20 lakhs and I tried checking. It's been quite some time, 11 odd years there, that I'm paying, and still I find the principal amount is intact. I mean, it really baffles me when they say that the load of interest is more in the beginning and the load of principal amount is deducted more in the later stages. And this is what I go about with seeing. And I tried checking out as to how much would I end up paying to the banker at the end of this 20-year term. I mean, it accounts to around about 60 lakhs. Now, I was blessed with a job. I don't have to depend on any other sources. God is my source, is what I believe there, the blessing that I get around. So, with that, what I would go about for telling is for a middle class kind of a thing that I come from, I can't aspire to go about with paying 20 lakhs down for buying a house there. Somebody claims that I'm in a own house, yes, but I think the papers are still with the banker. Now, we always like saying that we can get a tax deduction if you take a home loan. ATC is there. I mean, the principal and the interest amount can be deducted further to 2 lakhs, 1 lakh, and all that stuff. And when we have to pay tax to the government, we say no. And the bank guys are very good in creating a guise to tell that no, you get a lot of benefits by doing that and other things there. You'll have to figure out. And I still remember one of my friends with whom I had worked in Badruga. He had to save tax, or he had to reduce his tax burden. So he ended up buying some Vikas Patrikas. So I asked what it is. I was naive at that time. So I asked him what it is. So he said his money is blocked for the next 5 years. And after that, he can get that. And maybe he can reduce the tax part of it momentarily by buying those things. And he did seem happy to me when he had brought that Patrikas. I mean, Vikas Patrika, whatever it was. Because, it had gone about with making him to sacrifice the present consumption for a future return. So you'll have to work out what is called as your tax part of it in a better way. Let me tell you my own incident that is there. Especially to do with TDS, let me limit it. Now, I work in College of Commerce and Business Management at university, and every month from my salary, probably 20 odd thousand goes towards tax. And at the end, I think I paid quite a huge sum, like close to 2 lakhs probably. And God's grace, I do a little bit of training programs and go around different parts of the country as a resource person there. And maybe I have some money parked in the bank on which I get interest in other things. So a student of mine, a brother is a chartered accountant. So I had given him all my details to him, Form 16, what ma'am was talking to you all a little while ago. And Bhavani ma'am spoke about it. And that guy comes out by saying that there is something called as Form 26A. I'm not aware of it. I think this is something which my friend Dr. Aishekar will be talking about it in detail tomorrow. And he told out all the places that have been visited, the 10% that has been deducted by the organizations which have paid me, that is called as TDS. And when I have to comply with my tax returns, it is a blessing. It's not a curse to be in the 30% bracket. And I had to pay the 20% more. It was all nice. Probably I would have taken it a little more lightly, maybe giving this extra time because of the pandemic, people not having that resources to pay and other things. Government has extended it up to December and other things, then November or whatever. And I kept dragging it. Now the extra that I had to pay was close to around about 60,000 there, the 20% that I had to pay. And people can figure out what kind of income that I've earned this year. Then it happened that because I dragged it, I ended up paying 8,000 more as interest. You get this what I'm saying? Now this could have been avoided. Right? Last year too, I thought about it. And you'll have to look at those timing and other things. For nothing, I ended up paying that excess amount for dragging the payment. So these are things which we learn. It's okay that I probably didn't prioritize this part and put my head into the other things. That is the reason I had to pay out that fine part of it there. And facts and figures undergo a lot of changes, especially when it comes to tax. And I wish that the students also go about it focusing on learning what is called as interpretation of tax laws. The terminology that you get when it comes for tax there, it's quite different when it comes from the other laws that you have there. In fact, this is one of the papers I used to teach in Badruga when they had a course which is called as postgraduate diploma in taxation. This also continued at the campus college, and I remember teaching papers like wealth tax, gift tax, good old days coming as a part-timer to the campus to teach at that time. And I would tell you that it needs a little bit of street smartness to get yourself acquainted with everything to do with the aspects of tax. And once you master it, I know, especially when it comes to commerce and especially at PG and UG level, the teachers get respected a lot when you teach papers like accounting, stats, quants, income tax, costing. Theory papers, they believe they can learn it on their own. But I know by experience that teaching theory is 10 times more difficult than teaching the numerical papers. And some people shudder, they shy or run away when they say tax paper because every year the figures keep changing. My God, I'll have to do what is called as EPROM, erasable, programmable, read only memory kind of a thing there. Erase the past figures, put in new figures, and then start getting myself used to those kind of numericals and teach them. So that's a challenge. Yeah, that's the kind of a thing. But if you can make it through, nothing like it. So I just want somebody to go about with sharing with me. You can unmute and tell and mute back. I have my friend Rajshekhar sir also joining that. Now you can go over to telling me as to, you know, he said about 80 odd percent of the people from Gujarat are aware of taxes. Now maybe very small percentage are aware from Chhattisgarh. Not sure about the figures. I tried checking out how much is it in Telangana, Andhra, Tamil Nadu, Kerala, Maharashtra, because there are participants from these states also, Karnataka as well. Now, what percentage of population of this country pays income tax? Anybody will tell me? Yeah, once I start, I think I'll be rattling around. So the thing is, I want somebody to go about it telling me as to what is that percentage of population which pays what is called as income tax in this country. You have any figures with you? Anyone? How many people pay income tax in this country? I think when you look at the demographic and statistical numbers and other things there, we talk about something like little more than 130 crores is the population of this country.
Sir, I think 18%.
18%. My God, Venkatesh,
No,
if
sir.
that is true,
No.
I think our country would be at a very, very advanced levels at various things. Number one in many things. 18% is quite a big number.
Big number, sir.
Very big number. Very big number. Anyone? What is the percentage population of this country which pays? Yeah, somebody said 7. 7%.
Is it 4%, sir?
4% is also very high, ma. I think
3.2, sir?
1% has come. I think it
approximately.
is Sai Prashant. It's put as 2. I think it is close to that figure.
Sir, someone given 1.2%.
I think the figure is close to 2%. And some of the figures that has come in Bloomberg or in Economic Times and various other magazines, they say it is 1% of the population which pays the income tax part. Maybe that is something for research. You can figure out how countries abroad are able to work out on taxes and why we. Bhavani ma'am is still there in the session. I think I heard her telling that the tax authorities are 007. I mean, she was recalling the James Bond character there.
Yes, sir.
Yeah. I heard her saying number of times. They can figure out, they can sniff numbers and tell you what are your sources and they'll ensure that you pay. But I think there are people who go in different ways to ensure that they don't end up paying, and government is working time and again to get larger number of people coming into the tax net there. But people find ways and means, and if anyone is overburdened. I believe it is the salaried class. I mean, how many people have access to the PAN numbers, and how many people hide their income schemes, and lot of other things go into it. You know, ma'am said about income from house property. She said income from business and profession, capital gains, and then from other sources and all that stuff there. But I think if you look at the greater chunk, I'll come to it and show you like what part of that is what is paid in the form of tax there. Now, I have one request. I asked even Sandhya ma'am there. I mean, needlessly, if somebody feels bored, I don't think anybody has chained your legs to the chair where you're sitting at your home to scribble on the screen that I present there. At that point, I think I'll stop my presentation. I'll have to go back again. So the thing is, I'm putting it this way. There are some serious learners here. Let's give them some scope to learn. And the ones who are not the serious type there, who are there for the certificate or something of that kind, I think it's time that you quit the group, but don't involve in annotating anything on the screen. If somebody still says, I didn't fill Arshita, I think, who didn't fill the session 3 of day 1, don't worry. I would tell it to Venkat sir or somebody. They would take care. And another thing that is there is I've seen the patients with which Sandhya ma'am was taking a session that she would break in between, check the chat, and ask out, are there any questions, and come back. Maybe I wouldn't have that kind of a luxury, but I would go somewhere towards the end, spending some quality time in helping you out to ask questions. And unlike yesterday, where the session got dragged for a little over 7:30 and other things, and I had seen people saying that my charge is over, it is 15%, 5%, and other things there. I don't think that would be an issue. So I have little over an hour now to go about with sharing with you exactly as to what is this TDS, TCS, and advanced tax all about. All right. So let me get into the presentation mode.
Sir, click on screen share, sir.
Yeah, I'm doing it. I think
Okay.
doesn't have to
Yes,
that
sir.
quickly. Yeah.
Okay, sir.
Venkat sir, just handle the admits. I think that would
Okay,
interfere
sir.
with my slide transition in between.
Okay, sir.
I'm just looking for F5. Yeah, I think I got this going. Now, this is the topic which my friends have decided for me to talk on, what is ETDS and advance payment of tax. Now, I don't know if somebody can unmute, tell, and mute back. I really love this quote which says, nothing is certain except for death and taxes. There's a controversy how many people have gone about with saying, but there are 3 takers for it. There's one Benjamin Franklin. People say it is Mark Twain who has also said it. And another person by name Daniel Defoe. Now, I don't want this happening.
Dr. D. Prem.
Put him out. Remove him from the group. No
Dr. D.
compromise.
Prem.
I'll go back to my screen share.
Venkatesh,
Yes, ma'am.
remove that boy. Remove that student. Okay. If they are not disciplined, then let them not be there.
Okay, ma'am.
Please remove them.
Remove from the group.
Yeah.
Dear participants, please don't do like that. They will give inconvenience to the speaker. Please don't do.
Okay. Now I think I'll have to go again out of the thing and come back to remove that annotations around there. That was a height of stupidity on the part of the person who had done it. Okay. Now let me get back. I said this is something which goes very well with what my senior teacher, my guru's sister, that is Bhavani ma'am, had gone about with saying that you can't evade taxes. So there are only 2 things that are certain in this world. One is death, and another is taxes. Right? Now, I was just asking a question as to how many people pay in India pay taxes, right? And here, what we go about, I asked this question a little while ago. People had come out with a lot of guesses, and I have my student Venkatesh, who's a faculty at Palamur University, and I think he doesn't teach taxes, so he made a wild guess at 18% there. Now, this is the figure that you have. I share this entire PPT with Sandhya ma'am later on, and some of the statistics I've taken from various sources. I mean, if I've not quoted it, it's basically from incometaxindia.gov.in there. Now, this is from Financial Express that I've taken. It says income tax department. I mean, forget about that word Thursday when it was said. Probably I took verbatim of whatever was quoted in the newspaper. It says it's a mere 1.46 crore people pay tax on their income. It's very much close to 1% is what I put it. 2% is little more liberal. And it's around 1.46 crore individual taxpayers are liable to pay income tax. And further analysis of this says it is around 1 crore individuals out of this 1.46 who said their income is between 5 to 10 lakh. And God's grace, I'm in that bracket of that 1 crore taxpayers. So is my friend Ravi and Shekhar and Naresh and Sandhya ma'am and a lot of others there. And only 46 lakh individual taxpayers have disclosed an income of above 10 lakh rupees. And in crores, there is a very small number, the ones who have disclosed their income. Now, I want you to go through with this thing also. I think I've seen even Bhavani ma'am quoting from Mint newspaper there. Now, here it says that I think I'm getting somewhere else. Now, here what you find is you're trying to check out as to tax on property. I mean, that is with the red kind of a bar you have. The gray one is to do with corporate profits, and the yellow one is tax on personal income. Now, what you go about with saying is you're comparing countries with very good GDP around there. I think if you compare with all of them, I think personal income, Germany stands first, and then probably it's to do with UK, then France, then Japan, and then India. And if you look at all other countries that are there in this, probably India is the only country that you have where the corporate rate, I mean, the corporate taxes collected are higher in comparison to what you have is to do with the personal income tax that we have there. And there are a lot of things that you got to read between the lines and interpret what these figures go about with conveying. Now, this is something which I want you to go about with looking at as well. This is not going down. Okay, I'll find my best. Okay. Now here, if you look at it, probably ma'am has already told it there, but I'm trying to go with trying to repeat it again. There it says that the income tax slab rates with the new tax rate and the earlier tax rate, if you look at, if you earn anywhere between 0 to 2.5 lakhs, it is exempted in both the cases. And it from here it changes. That is, you're giving more leeway, but you have something hidden in it. You can't claim what is called as deductions and various exemptions that are allowed. You can't claim under the new tax regime. Under the old earlier tax regime, you can claim that, but the rates are a little higher. And it's up to the choice there. You know, if you would ask me which is preferred, we were asked to give a consent whether we go with the old or with the new. I mean, we have a word that we use in accounting, which we call it as the cost benefit analysis. So whether the cost is more or the benefit is more, we found that we were saving more with the older regime than the new regime. So we went with the earlier tax regime than with the new tax regime. There are a lot of numericals being worked out by Bloomberg, by Economic Times, maybe even by the income tax authorities themselves have gone about with working out some small numericals and exercises to explain in detail as to whether it would be apt for you to go with the earlier tax regime or switch over to the new tax regime there. So these figures are something which we go about with working. And apart from it, probably even Usha ma'am had gone about with sharing to you. Maybe that's something which you'll have to focus on, whether you are a resident or you are a resident but not an ordinary resident, or you talk about NRI. So that is residential status is the primary thing. Then we talk about the sources of income that are there, and you go about it figuring out in which bracket you come. So ma'am has very rightly said about the 5 heads and other things there. Apart from it, there is something called as the wealth tax and a lot of other things. Yesterday we had the Commissioner of Taxes speaking to you. He focused more on the indirect taxes part of it there, right? Now let me just move to the next one. So this is where I thought I could bring out to you. Now, if your taxable income is 4 lakhs in either of them with deductions, that is the earlier regime and with the new regime there, you don't have to pay any taxes. But if it is 7 lakhs is your taxable income, you know, after you undergo through with all those deductions from ATC to ATU that you have there, then after removing all those things there, you talk about the taxable income. and on that you work out. Then you talk about cess and 3% and other things that you have there. So here what you look is, under this regime, you under the old regime you pay 39,000. Under the new one, you pay what is called the 33,000. So you make a saving there. And probably you can go through with this example. This is something which I picked with the financial services. Someone is helping me out. Thank you so much. So what you find is, if you look at somebody earning 60 lakh and above, and what we would go about looking at is, you make a big saving when you go for the new regime rather than sticking with the older tax things. This is with deductions, right? So that is a huge thing. I still remember as students putting out charts and reading what is ATC, ATCC, ATCCA, then D and double D, then donations for G, 100%, and what is qualifying to 50%, and we had to mug up all that stuff like I still remember words like Maharashtra Earthquake Fund, Prime Minister Relief Fund, lot of other things. Probably today we talk about the COVID fund under that Prime Minister Relief Fund, and lot of other things. What you contribute to get tax deductions that come under. So you'll have to work out all those things that are there, and you know, we are trying to figure out these two words as to what is exemption and what is deduction first. Now, exemptions, when you look at it, is a taxpayer is free from paying tax on the burden of certain income. The best example that you can quote for that is to do with agricultural income, and that's a big chunk. Huh? People get wild when I go about with saying that why they are not being included under the gambit. They are to the vagaries of seasons, rainfall. These days, you talk about seasonal change, El Nino effect, a lot of other things there. But this is something which is exempted. And I still remember, vast chunk of our population depends on this as a source of their livelihood. Now, what does the word deduction mean is, it is removing certain investment and expenditure of the taxpayer while calculating. Let's say, for example, I take a insurance premium now for 20,000 or something there. So this entire amount can be deducted. So my taxable incomes get reduced, and my tax liability goes about with getting reduced further. So I want to draw this participants' attention to this, what our present finance minister has done. That in the old tax regime, there were 120 exemptions, and many of them have lost relevance. No one bothered to check whether it is applicable, it's relevant, irrelevant, and other things. And in the present system, they've been truncated. Some of them have become obsolete. And she and her team that is there had gone about with removing many of them. And after that thorough study, the Ministry of Finance has removed around 70 exemptions out of 120 are removed. So what you're left out is with 50. And when it comes to deductions also, I said it's something like progressive tax, retrospective, and all those words we use. But I tell you, sooner or later, the governments which come in future will go about with slowly eliminating the deductions. It's getting more and more simpler when it comes to tax. And I don't know if you keep in pace with reading newspapers on a regular basis. I tell the ones who teach finance and accounts, you are a criminal if you don't read newspapers. Forgive me for using that word, but you'll have to be more conversant with the things that are happening in the marketplace. And recently, I had read something about the tax, which said in one of the business papers, like from next year onwards, you would get pre-filled forms. You get it? Like, here in our university, we have the pre-audit. So they take in advance. I'm supposed to give those papers to them, which tells me how much tax is to be deducted every month. And they figure out all those numbers, and they tell out how much are they going to deduct and other things they work out. And what I have seen them doing is, I have to give them all the figures with all my details, PAN number, and other things. But now the government is saying that you will get it pre-filled now. You don't even have to do that. And every source, wherever they have deducted, gets complied there. All right. So that's something which is going to be changed, that's going to happen. And now the question is, if you opt out to the new tax regime, what are the exemptions that you'll have to forego if you look at it there? Maybe you'll have to forego leave traveling allowance. Maybe government had done a lot with it to expand the economy, make people to spend. They said that leave traveling allowance to be given to central government officials and other things there. HRA will have to forego. So there's a lot of calculations that you do here, talking about you belong to metro or a non-metro city in this country. Then you talk about the standard deduction. For a few years, It was done away and it was reintroduced. Maybe you'll have to forego that. And deduction that are available based on interest from savings on account deposits and other things there. Entertainment allowance and professional tax. We used to deduct it, and that again go about with reducing it from the taxable income there. You'll have to forego that. And the tax relief on interest paid on home loan for self-occupied or vacant property. Even this you'll have to forego if you go for the new tax regime. So buying a house on a home loan may not be that attractive in the years to come by. Maybe if you have upfront money there, you'll pay it and go about it buying, because there is no charm or there is no attractiveness of taking a home loan and buying it, because you can't claim the deduction anymore in future. This depends again. I mean, we are given a transition that is there. I mean, a change is not brought by shock or suddenly saying that everybody will have to go to the new regime there. So there is a transition that has been worked out there, and deduction of 15,000 allowed for pension scheme, and look at the tax saving investment deduction that are done under ATC. That is the biggest one that people talk a lot about. ATD, ATE for education, and D. Look at it, the one for donations and other things there, where people ask for receipts and all these things, except for one or two that are there to do with contribution to the pension schemes and other things that are there. Except for a few, I think all of them will have to forego. And what are the things which are still retained, even if you go for the new regime, is income from life insurance, agricultural income, standard reduction on rent, that is when you work out that income from house property. Then if there's any retrenchment compensation, leave encashment on retirement, we are allowed around 300 days if I remember, or yeah, 1 year's salary, 300 I think. You can't go about claiming more than that. Then the voluntary retirement scheme proceeds up to 5 lakhs. Above 5 lakhs gets taxable. Then it's to do with the death cum relief, a retirement benefit. Then money received as a scholarship from education and other things there. These don't get touched when it comes even with the new regime. Now, there are certain figures which were being quoted earlier before COVID and after COVID there. There were some figures which were being told. There was a kind of a thing which was issued by the government in the form of a geo. This has probably come in the month of May there, where I mean, if you still look at the websites, it still talks about the old figures that are there as to what should be taken as the TDS and other things there, but they got slashed to an extent of 25%. So that, I mean, that is one of the things people have those things there, where in advance tax, I don't have to pay the way I was paying it before. So that more money is there in my disposal. Try to understand this. This has got an economic logic there, wherein, you know, if you look at that working capital cycle, what we learn in financial management, we say there is finished goods. And if it gets sold, you get money. You sell it for cash or you sell it for credit. Either way, you're converting it to money. If you can get that bills receivable, you get it discounted with banks. Any commerce student would do that. And from the money that you realize from sales, you put it for buying raw material. And once you set it into the process of production, you call it work in progress. And once you recognize that the production is done, you call it as finished goods. This is a cycle. And at any point of time, there is a disturbance in the cycle, everything comes to a standstill. So the issue is, if you give more money into the hands of people there, they are willing to buy. So when they buy, the stock is getting converted to cash. But if they don't buy, the stock remains as cash. I mean, stock that way. It doesn't get converted to cash. Beg your pardon for that. And that is where you talk about opportunity cost and a lot of other things that are there. So if the stocks remain in the godown or in the warehouses without getting converted to cash, slowly you'll start stopping your production. That is where recession, and many have already said that it is set into our system. If it continues for long, it would be depression, something which had happened in 1929, which we call it the Great Depression, and people will be thrown out from jobs. So to avoid that, some people say, I mean, at the end I'll have to pay the tax, but now I'm given that option, more money into my hands. So I'm there to go about with spending. So that is the logic that is there, why the government had gone about with slashing the tax deducted at source. I'll just come to it a little into 1 or 2 slides from now. So what is the distinction that you draw between the words TDS and TCS? So bear this in mind. And I said this is something how the Indian economy earns. So personal income tax contributes, this is I think 1 or 2 years back, and things have not changed very drastically. We talk about corporate tax. They out of that only 28.1% is on. Now this entire component is to do with the, I would tell these two components are the, no, I would tell this is to do with the indirect taxes that are there. So customs, you collect 5.7% on the import duty and other things there. Excise, which is based on manufacturing, you collect 11%. On GST, you collect around 28.5% there. And personal income tax contributes only 26.3%. So that is where I said about that 1.46 crores out of 130 crores. And if things can be made, I think this can be made bigger. And that would contribute a lot because that's the only source of revenue to the government to work out its budgets and other things there. Now, you had Usha ma'am yesterday toward the end talking about the accounting terminology. So here, when you look at it, what is the period for which, and I'll put all my slides mostly on this question-based kind of a thing there. So it is what is the period for which a person's income is taken into account for the purpose of income tax. If you look at it, it is the income that is earned in the 12 months that is contained in the period, which is 1st of April to 31st of March, which is more often called as the financial year, and which is taken into purpose for calculating income tax. And for income tax purpose, we call this as the previous year. And the year when you're trying to figure out what is your tax liability, that year you call it as the assessment year. And the next thing is how does the government go about with collecting income tax? That is the focus that we are trying to figure out, not getting into the GST or the corporate tax and other things that you have there. Now, the taxes get collected from the five heads, what Bhavani ma'am had said in the first session today, is whether it comes by voluntary payments that is made by persons into various designated banks. Government goes about telling which banks would go about collecting your challans or other things there. And that is done through advanced tax or self-assessment tax. What is the distinction between these two words? You got to wait a while when I try checking on that. Then tax deducted at source, which is done on behalf from the payments receivable by you. And there is another thing which you call it as tax collected at source. So I said I'm going to bring a distinction a little while from now. On your behalf at the time of spending, right? There's a distinction, earning and spending part. So we all say that, we all know it like as tax abiding citizens. It's a constitutional obligation of every person earning income to compute his or her income and pay taxes correctly. So these are the three ways, that is advanced tax, TDS, TCS, is how the government goes about with collecting income tax. Income tax, we always go about telling it's to do with income from salary, house property, business or profession, then capital gains, that is short term and long term. Then you talk about things which can't be included in any of the four heads, we call it the other sources. So what exactly is this TDS apart from the acronym which is to do with tax deducted at source? Now, it is one of the modes of collection of taxes. What I tried telling in the previous slide, I'm reiterating it again here, by which a percentage of amount is deducted by a person at the time of making or crediting certain specific nature of payments. And this is the amount that is deducted and remitted to the government account. So I get salary from the government being a university teacher, and this is deducted from my salary, and I go about with what is getting is after deducting this, they go about with providing me. And let me draw this distinction. This is what I was trying to talk to you as to what is the difference between TDS and TCS. Try to figure out very simple way. By the end, I think you'll have to really figure out what is TDS, what is TCS, what is advanced tax, and what is ETDS. Now, TDS is tax deducted at source, is a mechanism where the payer deducts a certain portion of payment as tax. That is, my employer, registrar, and his team goes about deducting from my salary and pays it to the government. So this is TDS, right? So it provides technical service. There is a person who had provided technical services by name B. 50,000 is what it is. And the rates have changed. I said the government has recently slashed it to 25% as well there. So they deduct 10%, right? And I get only 45,000. Now, at the end of the year, when I go about with filing my return, so why do I have to file my return when already tax is paid on behalf of my employer? I'll just come to it in a moment from now. Now, the thing is, when I comply, pulling out all my taxes, it tells me in which tax bracket do I come. Do I come under 10%, 20%, or 30%? So they have deducted only 10%. So I'll have to pay 20%. and make good my tax return. Now, what exactly is TCS? That is tax. It is not Tata Consultancy Services with that acronym there, but this is tax collected at source. One is deducted, one is collected. Thin margin, but you got to understand this is out of what I need to receive, what I work for. There is a part which is cut out. See, I go for paper valuation or any other academic activity outside, like I do consulting or I do guest lectures and other things. So they pay me a honorarium, and they deduct 10% of it. I am a guest lecturer at NIFT or NART. They deduct 10% and they pay me. I've seen it over the years. Now look at this particular thing. Now, here there is a person buying a car which is worth 12 lakhs, and the person who's selling the car actually collects tax on his behalf and pays it to the government. So the actual cost of the car is 12 lakhs, but 1% of it works out to be, let's say, 12,000 or something there. So he goes about with adding it, and on the bill amount you showed as 12 lakh 12,000. How many times does it not happen? Like we go out to eat or anything of that kind, still it's baffling. My income is taxed, but again, when I go about with spending, again it gets taxed. In other countries, they call it transaction tax and other things. I mean, it's sooner or later it's going to come that you'll have to pay on what you spend and not what you earn. But God willing, I think it's the younger generation which is going to see that. So I said, this is something wherein on what I have spent, not what I've earned, if you go about looking at it there. So it is that mechanism where the receiver, who's, I mean, the car, I mean, automobile dealer, or wherever I go about with buying, let's say I buy a motor for my borewell or something, he collects a tax and he goes about with remitting it to the government. And again, you may ask about GST and other things there. It is an inclusive of those things is what we go about with talking there. And the other one is to do with what is meant by advanced tax. So I said about what is TDS and what is TCS. Now about advanced tax, I'll spend a little time on this and get back again to the tax deducted at source part of it. Now, advanced tax refers to paying a part of your total taxes before the end of the financial year. Now, this is also called as pay as you earn scheme. So I don't have to wait till the complete year. At the end, when my filing is to be done, then I pay. It becomes burdensome. I mean, I remember doing some training programs for the prison cell in Hyderabad at Chanchalgoda. I mean, before my session starts, I had a casual banter with the principal of that prison cell department where they give training to the police officials and others there. He was, in fact, a junior college lecturer, and he opted out for becoming a jailer. And I said, how do you find the transition, sir? He said, not much. In fact, there's more risk in my present job. Probably teaching I would have enjoyed. In fact, he was repenting why he had given up teaching there. And he said, there is very little risk there. And you get wonderful students and other things. He said, is by now, had I continued as a botany teacher, I would have become a principal of some government college, degree college by now. I said, what is that, sir? He says, look, I earned for 12 months, but 3 months I ended up paying as taxes, and I enjoy only the 9 months salary. That is what it is. And who's supposed to pay this and who's not supposed to pay, we look into that part. So here, if you look at it, if somebody's tax liability is more than 10,000 in a financial year, must insure. It should be paid in a year in which the income is received. And let's look at what these things are. What are the due dates for advance tax for assessee and other companies? If you look at it there, other companies, did I go? No, I think I should go back. Okay, other assessees other than companies I'm talking about, right? So here you'd say that the due date for installment, if you look at it, amount payable, if it is for advance tax I'm talking about, it's not less than 30% of the total tax liability must be deposited by 15th of September, and 60% of the advance tax of the total tax liability must be deposited by 15th of December, and 100% must be done by the 15th of March. So you'll have to remember the due dates, and that is for the earlier slide was for the assessees apart from the corporate assessees, and I'm talking about the companies that are there. So here even you have those figures there, slightly different. Here it is 15th of June, 15th of September, 15th of December, and 15th of March. And here you talk about 15%, 45%, 75%, and 100% that you do. And if you miss the deadline, what happens when you don't pay the advance tax. Maybe the slide gets slightly repeated twice there. If you fail to pay that amount, you're paid less than the mandated 30% of the total liability by, say, a deadline of 15% as an individual, then you'll have to pay, we all learned it in our school days, PNR by 100 and P into 1 plus R by 100 to the power n. One is simple interest and one is compound interest. So it is computed at 1% simple interest per month for the defaulted amount. You'll have to pay it for that 3 months. So 3 installments and 4 installments is what you've seen. And if the same interest penalty would apply if you pay the second deadline also, if you cross even December and wait for April, and that is what I had undergone. I said, ended up paying a little close to 8,000 there. And what if the amount you remit to the government in the form of advance tax is more than what is warranted? So what happens here is, if the amount paid as advance tax is higher than the tax liabilities, look at it. If you delay, you'll have to pay 1%, but if the government collects more from you, they pay you 6%, provided that amount what you get doesn't exceed 10% of the tax liability, the total tax liability, right? This is the other assurance that is given by the government. Now, what are the, I've told about this 1%, let me not reiterate again. Now, why do I need to file a tax return if my company deducts, or my organization? For me, it's not company, it is the university. Most of them are teachers here, or there are students who are trying to get employed in future. So you may end up in corporate or in academic jobs in future. So why do I have to go about with filing it? Here I decide that although tax is deducted at source and you're not liable to pay any more tax, is it compulsory to file returns if your income exceeds the basic exemption limit? Now, why do you file the return? Is to give a declaration to the government that you have derived income only from the source revealed by you, and the source revealed is income from salary. Ma'am has spoke to you about house property, from capital gains, then it's to do with business or profession, and then it's to do with other sources. Now, those things, I don't tell it to my employer, right? Where all I had gone for guest lectures, training programs, consulting, writing of books, getting royalty, and all that stuff there. I didn't disclose it to them. So the thing is, it's like this, people get annoyed. Why do I have to file again? I mean, you have written all the books, you got your hall ticket and other things there. In spite of it, when you need your TC, they tell that get that NOC. We see with most of the PhD students now, I think they are asked to get no dues certificate twice, once before the Viva and once when they're trying to take the certificate as well. So you're talking about no objection certificate is needed from the library. You're never stepped into the library, and you say you don't have any pending books. This is still fine if it is nil. Get a signature. Let the librarian certify, and you not certify it. So that's something which goes as an analogy here. And what are the consequences of not filing a return? Please understand this. Now, I think I'll reiterate what Bhavani ma'am also has said here. It is mandatory, compulsory, that you'll have to file your return if your income is above a maximum exemption limit. And if you're not filing any income tax return, it attracts a penalty of 5,000 and interest under various sections that are there. I don't want to dwell much on that. Further, if the original return is not filed within the due date, then the individual cannot go about with revising return. There are different types of assessments. You talk about self-assessment, best judgment assessment, compulsory assessment, revised assessments. A lot of assessing is trying to figure out what is your tax liability. So sometimes erroneously you file a return and you want to go about with revising it. But if you're not filed it, you forego or you forfeit the chance of seeking what is called as a revised return. The other thing is, in addition, losses such as business loss, capital loss, losses owning. Just now we had Sandhya ma'am speaking to you about set off and carry forward and other things there. It cannot be carried as per the sections that are mentioned under 80, section 80 of the IT Act. So all the deductions which come from 80C till 80U or beyond that, all of them you'll have to forego if you're not filed your return. So this is to be borne in mind. There is something called as 5,000 as penalty plus interest under various sections that multiplies. You can't go about with revising your return and you forego all the deductions. So that is something which is very serious when you don't file your return and do your payment before the due dates. Now, for my university employer, I have a PAN number, permanent account number. Now, how does the university or the corporate go about with paying? See, we talk about in companies law. Now, I've learned this 1956, but now we talk about the Companies Act of 2013. We talk about what is known as the artificial person status that is given to a company. All right. So here we say that TDS filing cannot be done by that. This is what even Usha ma'am was trying to say yesterday in the last session. There is something called as tax deduction account number, which should be procured. And this is the organization which goes about with working. Form 49B is there with the TIN Facilitation Center, which is from the National Securities Depositories Limited. In fact, I have a full-fledged PPT, which is given by NSDL as to how you do the ETDS part of it there. ETDS part of it. I think there's somebody who's come. One second, I need to open the door. Excuse me for that. Let me get back again. I said there is this form 49B, which goes about with having the TIN number, which is issued by the NSDL, which goes about with helping you to file the tax deduction at source. The next one is, this is something which my friend would go about with handling tomorrow, but all this TDS, TCS, advanced tax, they all get reflected with your form 26AS. So this is what I'm trying to tell. There's an annual statement, which is a consolidated tax statement, which has got all taxes related with TDS, TCS, refunds that are associated with a permanent account number. It shows how much of your tax has been received by the government and is consolidated from multiple sources like salary, pension, interest on income. And this form contains annual tax statement. It is, otherwise that's another name that is given to it under these sections that are there. And it is generated annually. And form 26AS will be generated whenever tax-related transactions, especially TDS is deducted or advance tax is paid, and it happens in relation to the taxpayer. And it is a live document, which means it's dynamic, it's not status. Now, whatever places people cut, whether it is a form of TDS or TCS and they're remitted to the government, it gets changed or it gets reflected in my statement there. And I wanted you to get to this other thing that you have, like only a registered PAN holder can view this 26AS. And this is an acronym. It looks very simple word like sample, traces, and other things. But what does the word traces stand for is tax deducted at source, reconciliation, analysis, and correction enabling system. It sounds very simple when you look at the word trace, but when you go about with actually checking this acronym, which is used by the government department, it is tax deducted at source, reconciliation, analysis, and correction enabling system. And this is there to go about with helping you to verify as what are all the sources where they are done deduction and remitted on your name and other things works out. You know, I have a account with SBI here at Tarnaka. So on whatever amount that I have, they pay me taxes on my current account and maybe my savings account or FDs and other things there. And that gets deposited. And 10% of it in the this form 26 gets reflected there. Maybe I've taken classes for HCU or taken some training programs elsewhere, they deduct 10% and show it all gets reflected there. So the address of reflecting in the annual tax statement, that's the other word I said, which is used for form 26, is picked up from income tax department PAN database with details of latest thing. And how do you open it? I think you know it, like it's to do with your date of birth. You'll have to put a date, first month and year format. That is the password for opening out that. Okay. Now, what is tax deducted at a source again, apart from knowing that acronym, if we are trying to move into it? We said it is for quick and efficient collection of tax, doing the right things is the word efficient, and doing the right thing in the right way is effectiveness. So quick and efficient collection of taxes, the income tax law has gone about with bringing this incorporated, and it is deduction of tax at the point of generation of the income. Right? So this tax is tax which is deducted at source and is commonly known as TDS. And under the system, it is the origin, the point where the income is to be given to the assessee, and tax is deducted by the payer and is remitted to the government by the payer on behalf of the paid. The provision of deduction of tax at source are applicable to several payments, such as it could include salary, interest, commission, brokerage, professional fee, royalty. It could involve contract payments, etc. It's it's not an exhaustive list that is presented here. So in respect of payments to which the TDS provisions apply, the payer has to deduct tax at source on the payment made by him, and he has to deposit the same thing, whatever is deducted, into the government account. I mean, there are serious repercussions if the person who's deducting is not remitting into the government account. So that part of it, we'll see to it a little later. Now, the other thing is where the tax payments are covered under TDS mechanism, what are the rates of deduction of tax? So this is something I said, the websites carry the old rates, and after 21st of May or something there, the rates have undergone change, especially to accommodate the purchasing power of the consumers of this country. The rates of TDS have been slashed. Even the rates of advance tax has also been slashed. So this is what the government goes about with giving year upon year, and most often it's not changed. So I'm just giving you screenshots what I would have taken from that income tax india.gov.in, two of them. It's only a sample, which says that for payment of salary, the slab rate, and payment of any PF and other things, or interest on securities and other things, that 10% is what is to be cut as TDS there. Maybe some other incomes are being worked out here for contracts, or look at it, these are capital gains, huh? Winning from way of horse races, or winning from lotteries, crossword puzzles, or somebody participates in that Kaun Banega Crorepati and other things. Flat 30% has been cut there. Right. We have rules for Hindu undivided family. We talk about Mitakshara school of thought, the Tayabaga school of thought. I mean, look at the rates that are there. How much do you do the TDS here? And for others, all those things are there. But I tell you, they have undergone a lot of change. And look at the other one. When you talk about levying of interest that is there, now here it says the government shall be deemed that an assessee is in default if there is the deductor. Let us say, in my case, it's the university which goes about deducting. And if they are not depositing into the government account, what is the outcome? They say that they are considered as assessee in default. I am the assessee. They have deducted a part of my salary to be remitted into the government account. It has never happened. It's been a little over 13 years that I'm working there. But in case that they fail to remit, then they are called as assessee in default. And in that case, they have to go about with the paying. This is how it happens. They have to pay 1% every month or part of the month of that date from which it was deductible. They are liable to be paid, the deductor. Okay. And at 1.5% every month or a part on date at which it is deducted, if it exceeds that limit, is the other thing that you have, right? And the levy of penalty. So that was about interest. This is about penalty. The penalty amount should not equal to the tax not deducted or paid, should be imposed. So whatever is to be deducted, they would end up being paying because you have defaulted in depositing into the government account there. Now, the Central Board of Direct Taxes had gone about with issuing various things, especially because of COVID related, some changes were being made and extensions were given. In fact, our salaries were paid 50% and you couldn't collect taxes, and a lot of things had gone. Many people had ended up jobless and everything there. So there were certain provisions that were being created, and they had gone about with reducing it to the percentages. The interest and everything. Earlier it was 1.5. They brought it down to 0.75% and other things there. Under what circumstances a deductor would not be deemed as an assessee in default, where a return is furnished under section 139. Now it goes about saying they've complied with everything, and they go about with getting a certificate from a chartered accountant saying that everything was done, and they've taken this income into consideration before doing it. When they can go about telling this, they can be exempted. That is the deductor part of it. And what are the duties of the person deducting the tax at source. These are some of the things. He or she shall obtain the tax deduction account number, that is TAN number as called, TAN, and quote the same in all documents pertaining to TDS. In fact, on my form 16, I get this number, TIN, TAN, and a lot of other things that are there. And he or she shall deduct the tax at source at a rate which is applicable. This year was a bit of an exception, especially due to the COVID conditions and other things there. Now, he or she shall pay the tax deducted by him at the source of the credit of the government there within that specified due date. And TDS statements, TDS return is to be generated for every quarter. And he or she shall issue that TDS certificate to the payee in respect of that tax deducted by them. So we get that form 16, which goes about telling. And it also gives a composite figure from all the employees, what amount of money was deducted and remitted into the government account. Even that figure is quoted, the date, the number, which is the TAN number of the university, and all those things come in that form 16 to us there. So I put that asterisk to tell about the rates which keep changing, right? Now, how can I know the quantum of tax deducted from my income by the payer? If I can get to that form 26A, if I have a PAN number, I can go to that income tax website, which is to do with incometaxindia.gov.in. And from there, I go about with getting into those details. And you must have a PAN number for that. And this is the website, that is incometaxindia efiling.gov.in. Or there's another thing which I'm saying. I said to the foreign students or anyone who's a novice, I still remember teaching to GenPack students long ago. There was a course which we are running parallelly from the university at the Center for Distance Education. Weekends, the students used to come to classes. So I said, at that time, I still remember 140 odd questions were there. And I used to make them read and understand. And you get a firm grip on what are the basics of tax when you get through those FAQs, which are being listed out on this incometaxindia.gov.in website there. And what to do if TDS credit is not reflected? It has happened to me. Like when they were giving me an income or a honorarium. Now remember, ma'am has said about the word salary. Now for the word salary, there must be a servant-master relationship. Like in the university system, there is a servant-master relationship. The government is a master and I'm a slave, or I'm a servant. I'm a government servant. But when I do my guest lectures at NIFT, that is National Institute of Fashion Technology or National Institute of Rural Development at Panchayati Raj, NIRD, there is no servant-master relationship. And I'm treated as a guest faculty. And what I get, it doesn't go with the word salary. Instead, they use a word what is called as honorarium. So I've seen some places, I don't say these two, but I've seen some other places, while giving me, they've gone about with deducting the TDS. But when it comes to my filing of returns there, the 10% that they deducted did not get reflected in my returns or in my 26A. Then it can be few reasons. One is it's a criminal act if they don't go about with trying to deposit it. I said it's a crime, right? Not a criminal act. And the provisions that are related with penalties and interest which the deductor has to pay if they have not deposited. Or probably they have quoted a wrong PAN number. I don't know how many of you all remember your PAN numbers. Mine is AP ET 2K 1026 or 1026 and 2K comes in the end. Even I'm baffled trying to recall. So maybe even if I make that alphanumeric one number here and there or one letter here and there, things go haywire. But it is nice, for what your work you're being paid and somebody's deducting it, you got to ensure that it goes into the government exchequer and rather than somebody pocketing that amount that was deducted. And at what rate will the payer deduct if they do not furnish? There are some places like they say that I don't know, I don't have a PAN number, so don't deduct my 10%, pay me. No, that's not possible. So here it says that if you give your PAN number, they deduct 10%. And your income is within that, below that 10%, you can claim whatever tax was deducted. Let us say my wife had also taken some classes for NIFT and her income is within that basic limit or something there. So tax was deducted by them and that can be claimed back. But the thing is, if you don't quote your PAN number, they would deduct 20% straight. And at times, I would tell another thing that is there is there are some places or countries which are considered to be not cooperative with the Indian government. or let us say they're called as tax havens, or companies which are with animosity with this country. Let us say that, notified cases or something it's called, and there they deduct to an extent of 30%, all right? And would I face adverse consequences if instead of depositing? This is, I'm talking about the one who's deducting it. Yes, the failure to remit tax deducted by me, that is by an employer, not by the employee and not by the taxpayer. I'm talking it from the point of view of the deductor and not from the point of the deductee. So government account within the stipulated time, it would attract, look at these words, penalty, and it could involve what is called as rigorous imprisonment up to 7 years, right? And then whether TCS can be collected on amount inclusive of GST, this is what I was trying to tell. Here it says amount debited to the account of the buyer. Somebody is buying a car or property or something of that kind. They'll have to do the payment received by the seller, which is inclusive. Maybe we had these things earlier, but now we have only this GST part of it. So TCS, that is tax collected at source, is to be collected on inclusive. It includes GST in that. And little more on what is this, this is bugging, right? Now a little more on what is this advanced tax all about. I did TDS and other things there. So the taxpayer goes about with estimating what is annual tax in advance. And this is required to be paid in the financial year in which the income is received. And it is something which I've already said is to do with the word pay as you earn kind of a scheme. So in case of salary taxpayers, tax on salary deducted and paid by the employer, right? So whoever is the deductee, and I told, except for someone like a doctor, an engineer, there are few professions that are there. They don't have to pay it. They can pay it by March 31st. You can look at 44D and other sections that are given to them as exemptions. Now, these are the due dates, which I've already mentioned there for the individuals and the companies that are there. And who are exempted from paying the advance tax? Senior citizens who do not have any income from business, right? What ma'am said about 5 heads. If they don't have this, senior citizens above 60, they come under that. And others having tax liability, which is less than 10,000. So after considering TDS and tax relief and everything, they don't have to go about with paying advance tax. Now there's another thing that is there, self-assessment tax. Now, way within margin, what is advance tax, what is sales assessment, and what is self-assessment, and what is TDS part of it there. So assessment in simple terms means estimation. We said about assessment here in previous year, calculation of income and taxes thereon. So taxpayer is required to consider all incomes, that is income from salary, capital gains, business from profession, interest dividend earned by him during the year. And after all the eligible deductions have been subtracted, so that you come to know what is the taxable income. So taxes paid by the taxpayer earlier in the form of advance tax, in the form of TDS, shall be deducted. And once I look at that form 26A, I come to know the other places where they've cut it. And I said it is a dynamic statement that you have there. You can pay it if you want to avoid the interest and other things that come in. So that is something which I come to know after removing what am I still liable for. So I'm trying to figure out myself. It's very easy. I'll tell you, there are umpteen number of websites which give you what is called as a simple tax calculator. All it requires is go about with filling those columns there. It will tell you flat, this is the amount of tax that you'll have to pay. You can take a print, you can generate a challan, go about with depositing in the account. I already have an account with the SBI. I put a check, I put this challan, they gave me a number. I gave it to that student's brother who had gone about filing my return. He went about it entering. Back comes my reply, and he also does. I get an OTP on my mobile, and I tell it to him. I could have done it myself there, right? To be doubly sure that I have not many other things to bother about. So I would say that it is an outsourcing kind of a thing at it, like somebody else will handle, but it is very simple. It's not that difficult. So I gave him, and I did my e-verification also was done, and I have no hassle. So in case they come to know that some figure was missed out somewhere and it comes to their account, they would call me to say that this amount of tax is to be paid, and that's it in the best of interest that is there, I have to do it. So I said this is all about filing. And what are the basic difference that you have between advance tax and the self-assessment tax? If you look at it, the taxpayer will have to pay advance tax if he is a salaried taxpayer with some other sources of income like interest, fixed deposits, and other things, and having a tax liability more than 10,000 after deduction of TDS and other things. So advance tax is paid in the financial year preceding the assessment year, previous year, as you call it there. So it, as I said, it is pay as you earn kind of a thing. So this payment is done mostly in three installments, that is dates being 15th of September, 15th of December, and 15th of March. We are very cautious about the income tax part of it. So self-assessment tax is paid in particular assessment year before you're filing your income tax return. That is the last part of it, right? So it is during the assessment year is what you do. And while you're calculating your tax liability, you might realize that some of your taxes still due after even doing TDS and advance tax. In such a scenario, you got to pay the tax that you pay is called as the self-assessment. Try to draw this distinction. I said, pay as you earn is advance tax. Now, when I'm about to file my return, I realize that there is still some amount due that I have to remit to the government. And that I figure out based on whatever things that I do from my Form 26 and other things which my friend would dwell upon it more tomorrow. So with that, if there is something I have to do, then that portion of tax which I have realized I have to pay is a result of self-assessment. I have assessed myself, right? And further, when it comes, how do I pay the advance tax? When it comes, you have this government portal. So when you open it, it goes about telling this. Of course, I've taken some screenshots to show it. So on the page, you fill that mandatory fields that are there. You talk about the self-assessment. You select the type, and 100 is meant for advance payment of advance tax type. There are serial numbers, codes that are mentioned there. You select the bank through which. So in my case, it would be SBI. Someone's case would be Canara Bank or HDFC or ICICI. Right? There are a few banks which are there, and you understand what a captcha means to ensure that you are the one who's genuinely using the portal and there is no misrepresentation that is happening. So I have to fill out all these dates that are there and enter the captcha. It takes me to the next thing, which is to do with e-tax PIN number and the e-tax payment and other things there. And you'll be redirected to the net banking account. So you get an OTP and other things there, and you figure out that is what is done. Now, once the payment is confirmed, you will get a challan or a counterfoil, all the details of the payment. You'll have to keep this safe. Somebody says that, there are times that can happen that nick of the moment, there is a power failure or a network break. There are times that from your account, the amount is debited, but into their account, it is not gone. So you may need some kind of clarification. So you need to keep all these things, take a screenshot or, we are doing all, I have learned commerce as a student. The next generation has done what is called as e-commerce, but the present generation is all to do with mobile commerce. So you may do it, filing is as simple as doing it even with your mobile handset as well. Or you can visit, this is what I have done, that is went to the nationalized bank, that is SBI, and did the payment through challan which was generated. The safest way. I'm still a traditional old generation guy. Probably I don't insist on using of these. I had my aunt working for RBI in Mumbai, and till date she doesn't believe in anything to do with the internet related or online banking transactions. She's very scary. She says, I can't trust him, kind of a thing. And probably being a nephew, I'm a little more on the lesser risky side, but still I have my own apprehensions when it comes for cyber frauds and other things that happen. Like time and again, you've been reminded not to share your PIN number and your personal details of bank and other things there. So we all learned about Contract Act, and then it is about IT Act of 2000, with a lot of amendments. And today we talk a lot about cyber frauds, right? So that's something for the future. So in the TDS statement, if you look at it, so I said it goes about with telling you all the details that are there. Now we get into this electronic eTDS, and I said NSDL has given a 74-page PDF presentation, which is a tutorial. And at the end of my presentation, I'll share it with Sandhya ma'am. and she would probably share it in the group or at a later stage with all of you all there. Even the links that I promised, and my PPT also I would share with ma'am. So it tells you certain forms that require for filing apart from the form 26A we said. Now we come to think like what is form 24Q, especially when you're doing the electronic tax deducted at source kind of a thing. And what is 26Q, 27Q, and these statements are filed with a compact disk or a pen drive. It should be accompanied by a signed verification form number 27A in case of both. Like, that's a huge university with little over 1,000 odd non-teaching and little less than 500 teaching staff. There are companies with 10,000, 20,000 staff. So you go about with putting all this data in a CD and or in a pen drive and submit to the government. Now, that is from the deductor point of view, what I say. Now, who's required to file the TDS? As per the Income Tax Act of 1961, all corporate government deductors, collectors are compulsorily required to file the TDS or the TCS statements in an electronic form. And that is what is the e-TDS, or, I mean, you are using these two things synonymously. That's the reason you're separating it with an oblique symbol there. You're calling it as the tax deducted at source or the tax collected at source return. Now, there's another thing. However, deductors or collectors other than corporate government can file their returns in physical or in electronic form. So it's for the government and the corporate, and you are given a choice there. And who is the person who goes about with looking at the e-filing? It is the Central Board of Direct Taxes has appointed somebody is called as Director General of Income Tax Systems, and they would look into all these things about e-filing administration related with the online. Today we're talking about everything to do with online. So TDS and TCS, if there are any discrepancies or any flaws and other things there, so it comes under their purview. Now, who's the intermediary? I still remember we had a senior head of the department, Sulochana ma'am. Today she's with Andhra Pradesh. Long back, she had gone about for doing a workshop on role of NSDL. I didn't realize that they would get this task today. Today, you talk about your banks are doing RTGS, that is to IDRBT. But you talk about SHIL, NSD, a lot of these organizations, when they do other aspects of dematerialization, they keep your stocks or shares in electronic form. Now, this organization is given the role, right? Let us say that I had paid LRS recently, and I looked at it, who's actually handling this entire payments, either through the Me Seva, E-Seva, or I can pay it online kind of a thing. It is Center for Good Governance. And the government of Telangana had given them the thing, you talk about your intermediate results. There is somebody safeguarding it. And who takes care of the TDS and TCS? I said about the administrative part from the Central Board of Direct Taxes. And the person who is a conduit between the people who are deducting and the government, that is Central Board of Direct Taxes, is to do with this NSDL e-government. I said about National Securities Depositories Limited there. It's a Mumbai-based organization, and they care for facilitation of issuing the STIN number, TAN number. And I said I'm sharing that 74-page note e-tutorial what they had given. When you go through it, it gives you detailed step-by-step process, drawing your attention as to how do you go about with doing the e-TDS filing and other things. Now, how do you do this online filing? Now, here you have a data structure format in which you go about doing it, which is mentioned. And you would get to this website. Then you have to go about with looking at the format in which they go about it. It keeps varying at times. You talk about TXT ending with text, and you talk about whether it is PDF format, and they take it in the text format there. And you do what is called as return preparation utility, is what is done by third-party software. Now, this is done by NSDL there. And once the file has been prepared, it should be verified. I said about e-verification when I do my return filing there, but here there's called as FVU, which is File Validation Utility. This is provided by NSDL. And in case of any errors in the file validation utility, it will give a report of the errors, and you'll have to rectify and verify the file once again through the FUV, so your file number and everything. So once all these things are done, now that is where the TDS is done. So what is this TDS certificate if you look at it? they are issued by the deductor, the person who's deducting the tax, the deductee, that is the employee, I would say, from the person whose payment the tax is deducted. There are mainly two types of TDS certificates that are issued. Ma'am time and again was referring to what is called as Form 16, now which is issued by employer to an employee, incorporating details of tax deducted by the employer throughout the year. Now look at the other one, which is Form 16A, which is issued to all cases other than salary. So this is only salary, this is other than salary. So your certificate will have total validation unless the officer goes about with cancelling. The TDS collection is an ongoing basis. It is difficult to keep a track, but you can always go. But I said it is a dynamic thing that you have there. So wherever remittance is done, it gets very quickly reflected if you quoted your PAN number and other things correctly. So I think that's it. So sometimes I can request the tax authorities not to go about with deducting any money. There are some provisions for it. What are there if my salary before the taxable limit, or if it's a senior citizen and other things that are there, and how much tax should be deducted. And I told about the exemption limit, which is said. So 15% of the salary part, or it should not cross that exemption limit, or it would involve all these basic allowances that are there, and you give scope for all the deductions, and then you go about with working out at, you have the 15%, 45, 75, 100, which you'll have to pay before the 31st of March kind of a thing. So the due dates I've said is to do with what these figures are. So for corporate, you have separate, and for an individual assessee, you have separate dates that have been quoted, which I said. Now, again, when you talk about the TDS return, the deductor type that you have, if it's a salaried class, you have Form 24Q. If it is a non-salaried class, you have 26Q. And deductions are made in case of non-resident Indians. It is to do with Form 27Q there. And due dates are different for different quarters, as you call it. So for 24Q and 26Q, 27Q is for the NRIs. So this is April to June is 15th of July. And for July to September it is 15th of July. Here you see it is 15th of October for an NRI. And here it is October for December quarter, it is 15th of Jan. 15th of Jan. By all means, January to March, it is same. Only here there is I suppose, there's no difference. It's same for both of them, but it's only the forms which go about it varying. I'm just looking at my time part, nothing more. I think I've come very much close to the end of my presentation there. So there is this challan form, which is for payment of the tax deducted at source or tax collected at source. There is a challan which is applicable for corporates and non-corporates as well. All right. So thank each of you all for your patient listening, and thank all my colleagues, especially Dr. Ravi, what gone about with contacting me and gave me the choice of the topic, time, date, and all that stuff there. I'm really enjoying. I would go about with attending the other sessions also. Forgive me if I was rude with the person who was trying to annotate, but that was not my intention to put somebody low, but to ensure that I don't get distracted. And you see there are little around 130 odd, 10 people probably disappeared or vanished from the group there. But whatever it is, I did have a lovely time of doing my sharing of things, what I had to do about the topic of TDS, TCS, advanced tax, and ETDS part. So if there are any question and answers that I get from the audience, I would love to do that. If not, I leave it to Roja Rani ma'am. And thanks to them.
Yeah, thank you, Patrick Anna. Thank you. Thank you.
Oh, thank you so much. Ravi sir is there. The director for this entire 1 week program. So we share one moderator. He joined 2007.
Yeah, because of
OU there.
Yeah, because of elections training class I have taken. That's why I joined a 5:30 for your class.
Okay, sir,
right,
Patrick sir, thank you so much for accepting our request to be the resource person for this session. Not only this session, any workshop, whichever workshop, whenever we request you to be the resource person, you readily accept, and whatever topic we give, you prepare, and then you contribute with lot of ease, and you provide valuable inputs to the participants. It was a great learning from you. Thank you so much for being the resource person for this session. Thank you, sir. I request Roja Rani
I see
to.
a lot of questions in the chat there.
Yeah.
But I don't know if I have the time to take. I don't see any messages. Clear explanation.
Sir, they are asking about the PPT, sir.
PPT I'm going to share invariably with ma'am. So she would share it with you.
Definitely will share, sir.
Yeah, I would do that. And I would share the links of videos and whatever
Thank
is
you
the
very much,
topic
sir.
material that I've taken up. Yeah.
Okay,
Thank you,
dear
sir.
participants, 1 second, ma'am. Dear participants, feedback link and session 3 attendance link is posted in chat box. Please complete the process.
Yeah. Thank you, sir. Once again, it's always a worth wait to listen and learn from you, sir. Your commitment towards any seminars or this session in particular by making us keep to learn more is impeccable and commendable, sir. Thank you so much, sir. I once again thank you all the resource persons for inputting your great knowledge into us. And I would also like to thank all the participants for attending today's session. And one announcement, dear participants, in tomorrow's workshop, we have 3 sessions. The first session is on tax planning by Dr. Ravikumar Jasti sir, and second session is on investment avenues tax consideration by Mr. Prudvi B sir, and third session is on Form 26 accounting standards and e-filing by Dr. I. Shekhar sir. So please do attend tomorrow's 7 days workshops. That is third day, sharp 2 p.m. of 7-day national level online workshop, financial literacy on income tax and GST, a practical approach. Thank you once again. Thank you for giving this opportunity, ma'am.
Thank you once again to Ravi sir, Sandhya ma'am, Roja Rani ma'am, Venkatesh, and all the participants. Big thank you.
Thank you, sir. Thank you very much, sir.
Yes, Venkatesh, you take care about the feedback and attendance of all the participants.
Okay,
I
sir.
take leave from there.
Okay.
We'll see.
Sir, Patrick sir, thank you, sir. After a long time, once again, I listened to your class.
Yeah.
Right.
Nearly after 10 years.
Thank you, Roja, for taking care of the session.
So it's my pleasure.
Yeah, can we leave Venkatesh all? Will you take care?
Or shall we have one pick, Venkatesh?
Yeah, Patrick sir leave an today. Venkatesh, pick this participants.
All the participants. Maybe all the participants can on their video.
మేడం మీరు ముందర చెప్పాలి.
సరే రేపు చూద్దాంలేండి. రైట్ మరి.
ఓకే.
రవి సార్ తెచ్చుకున్నారు. రవి సార్ తీయండి ఒక పిక్చర్.
నేను ఇలా అలసిపోయినా మేడం.
నేను తీస్తారు అలాగే ఉండండి. మీ బ్యాక్ డ్రాప్ బాగుంది. ఆగండి ఉండండి అలాగే ఉండండి. తీసాక చెప్తా తీసినట్టు ఆగండి.
ఓకే.
Yes, sir.
Right. Thank you, Bhavani madam. Thank you.
Thank you, sir.
Yeah.
Thank you.
Okay, thank you. Bye. Yeah, thank you to all for wonderful participation. Now we have more than 130 people are there in this group. Thank you. See you tomorrow. Right. Thank you.
Bye.
Thank you.
Okay, sir. Thank you, sir.
Thank you, Venkatesh sir.
Okay, thank you, ma'am.
Dear participants, do join back tomorrow on time, sharp at 2 o'clock. Bhavani madam. Background ballad, madam.
ఉండండి.
Okay, ma'am. 1 minute.
మీరు కూడా అనండి.
నేను రాలేదు. అందరూ చెప్పాలి.
Dear participants, please complete the process.
Excuse me, ma'am.
Yeah.
Ma'am, is there any WhatsApp group?
Yeah, we have a WhatsApp group.
Already I posted WhatsApp group 4 link in the chat box. Tomorrow also I will try to post. Those who are not joined in till now in chat WhatsApp, please join tomorrow also. Okay.
మ్యామ్ హలో
Yeah. Any doubts?
మ్యామ్ నేను నిన్న ఫీడ్బ్యాక్ చేయలే మ్యామ్ ఏమైనా ప్రాబ్లం అవుతుందా
ఫీడ్బ్యాక్ ఎంటర్ చేయలేదా? వెంకటేష్ ఏం చేయొచ్చు?
చూద్దాం మేడం. We will discuss later.
Yeah. And how about today's second session and third session attendance, Venkatesh?
Already posted madam. Posted in the chat box. Yeah. Okay. Can I close now?
Yeah, please close.